our core view is still one where you're going to see economic growth resilience.
Yield curve is a very powerful signal that we might be seeing a very big slowdown in the economy.
I'm not sure that disinflation the market was really grabbing onto at the start of the year is necessarily going to come through.
Over the second half of this year, you are going to see the consumer pause.
I think that markets are trying to sort of, frankly, start ignoring 2023. I think people are ready to get past it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
You know that scene in Love Actually where they get him to say bottle in the bar?
Really?
Yeah, that's what Bramo's doing to me in the commercial break. Yeah.
Well, you said
just getting me to say words.
We can't say our T's. So
well, you use D's instead.
Bottle.
There you go. That's beautiful. That's
you.
lovely. From New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Equity futures positive 0.2% on the S&P 500. Chairman Powell on Capitol Hill a little bit later this morning, TK, in front of the Senate Banking Committee.
What's he going to say or not say? He's going to be very careful about what not to say, and that I think will be the interesting part. With Greg Bottle coming up here, I think it's going to be interesting to see the scenarios he lays out, and those scenarios are the same ones the Fed has.
It's really difficult for him today because he's up against the calendar, and we've talked about that calendar a few times already this week. Lisa, on Friday we've got payrolls. Next week we've got CPI, and CPI falls in the quiet period, so it's not like they can undo whatever he says today, and I think that makes today just that little bit more complex.
Especially because the data has been coming in hot. There was a story about how payrolls have come in hot over expectations for 10 straight months, which is the longest streak going back in decades. We've been talking about the Elizabeth Warren side of things. How much is there a concern that they're trying to kill jobs? I'm worried about the other side. People saying, what are you doing about inflation that is too high and that continues to surprise to the upside?
The inflation's there, but you know what I'm going to see here within all the economic data, the anticipation of the data, we're all data dependent, is John, the market's walking away from the bears. I see an angst to the bears, and to see what Mike Wilson has done, to me, is buried in the news flow of the last 48
Mike
hours.
even acknowledging that maybe, at least in the short term, we can have a lift in this equity market.
Yeah, I mean, I think it's been underplayed, is that the bears are starting to, it's not that they're rationalizing a bull market, but they're just saying, okay, let's revisit our caution and when that caution clicks in.
The pushback coming from Chris Harvey of Wells Fargo, who won't even call this a bear market anymore. He's saying it's not a bear market. JP Morgan, Mislav Matejka, Marko Kolanovic just saying no. That Q1 strength does not carry over to the second half at all.
Here's the issue that people have. People were expecting softer earnings. They got softer earnings. The response in markets was not what they were expecting. You did see the earnings expectations come down, but markets didn't follow in tandem in the same way people had forecast out.
Well, leadership came from tech to start the year, and Meta is still absolutely flying. Meta, by the way, according to our latest reporting, set to cut thousands more jobs, perhaps as soon as this week. We'll pick up on that story in just a moment. I'm going to whip through the price action just briefly. Equity futures up 0.2% on the S&P 500. Yields come in just a little bit, down by a couple of basis points, 393.24. Yesterday, the Austrian Central Bank governor of the ECB teed up, Tom, 0.5 percentage point hikes 4 more times. That's 200 basis points of tightening from the ECB.
I mean, Austria's got their own voice within the conservatism of the central nations, the Bundesbank. And if he mentioned my ownership of the 97-year piece down 71%.
He didn't pick up on that. I'm sure he remembers that time we met on the plane on the way to Jackson Hole.
That's a great idea. I'll buy that. Great.
I said, Tom, that's the biggest hawk on the ECB. And then TK strikes up a conversation. What were you talking about?
Bonds.
Century bonds.
What do you got that I can buy? And he goes, I'm sorry, it's not 100 years, it's 99 years. And there I was at 110, 115, and you're loving it down 71% right now. That's called yield up, price down.
Yeah, do you want to hold that to maturity?
Yeah.
We can try. I don't think we'll be around for that one.
Yeah, well, I think that this is going to be the issue, especially if you end up with yields that much higher, that you're going to have to hope to be around in 2010, I believe, is when that bond matures. All right, here's what we're looking at today. Adam, you were talking about Mike Wilson coming out and kind of caving a little bit to the bullish sentiment. He is chief U.S. equity strategist at Morgan Stanley, and he's gotten it right so many times. But here's the issue that I really want to hear from him. He's actually been right about a lot of the earnings, about a lot of the economics, and yet he hasn't been right about the market response to it. So what do we take away from that? Who is driving the market action? Is it quants, or is it perhaps something else that is going to reset his expectations. 10 a.m., this is the main event. Fed Chair Jay Powell testifying before the Senate Banking Committee on Capitol Hill. Tomorrow he goes to the House. Here's my issue. I really do think that the bigger concern for him is explaining how far they have to go to fight inflation and whether they've gone far enough, whether they've actually done enough to dampen financial conditions, because that, to me, is going to be some of the bigger concerns on the main group of senators, not necessarily the concern about employment, because employment is so strong. And at 3 p.m., we get U.S. consumer credit. And here's the issue with that. I'm curious how much people are reducing their credit card bills with higher rates versus the opposite, borrowing to continue their spending as their savings get whittled down, John. We talk about the consumer. How long can they remain resilient? How long can they keep spending? Consumer credit might give some sense of where the sentiment is on that front.
Lisa, thanks for that. Let's kick off the conversation this morning with Greg Boutel, the US Head of Equity and Derivative Strategy over at BNP Paribas. Greg, wonderful to hear from you. As always, sir, good to see you. A little bit later this morning, we catch up with Chairman Powell down on Capitol Hill. What are you and the team looking for from the chairman?
Yes, I think everybody's going to be going through this with a fine-tooth comb. You made the point at the top of the show that there is really a problem in terms of the sequencing of the data here. We're going to hear from Chair Powell today, tomorrow, but the real problem is what the Fed are looking for is the data, and Powell isn't going to have the data. So Friday's payrolls number is really going to be a key print. After we saw this massive positive surprise in January, we're looking at whether there's some seasonality, some one-off factors there, or whether there is actually a kind of more sustainable hawkish narrative coming through the labor market, and that's what's going to drive the Fed.
Greg, you talk about one outcome, which is a Goldilocks outcome. Let's go there right now. With a Goldilocks outcome, what do central banks do, and what do the equity markets, how do they respond?
I think the Goldilocks scenario that we see is the least probable of the outcomes, and it's really what the market's been pricing at the start of this year, the U.S. equity market. It's this idea that we do get this gradual fading of inflation, and the Fed are able to engineer this no landing or soft landing. We still get robust growth. We don't get a collapse in margins. We don't have to see a large correction in the labor market, a large pickup of unemployment, and that contains inflation. Seems probably a challenging or very narrow runway to land on.
What I see right now, and I'd like you to fold it into derivative strategy, there seems to be a shocking partition in the market between profit and free cash flow generators and non-profitable companies. How do you see that within the derivative market of almost a bipart market?
Well, certainly one of the things we've seen at the start of this year, Tom, has been price action that I think has been quite divorced from fundamentals. So we've seen this deterioration in terms of the earnings picture, yet we've really seen some very strong outperformance of some of the kind of least profitable or lower quality parts of the tech or growth spectrum of the market. We have a basket that we track at BNP, but it's called our squeeze basket. And it basically consists of the names with the largest short interest and the names that have seen the largest open interest in call options increase over a monthly basis. And this basket really peaked at the end of January. We've seen a little bit of a reversal since the rates market has started to reprice, and we've seen slightly higher rates. So our opinion is that this was largely technical, and we think that it's going to start to fade.
So let's lean into this idea that the fundamentals are somewhat divorced from what we're seeing in the market. I was reading an article about the increased use of quantitative trading and momentum traders and how they seem to be leading the charge so far. How do you sort of game that out when coming up with a forecast of when they sort of hit a wall and are forced to reckon with fundamentals that you say are very different?
I think the thing about quantitative strategies, and we track things like vol target funds, CTAs, other kind of factorial exposures, and what you tend to find is that these things don't tend to set the direction of the market, but more tend to amplify the moves when we get them. So momentum, trend following, by their nature, are exacerbating the moves that we already see in the market. So I think it is fair to say that the stronger start we've seen to equity markets here is not entirely divorced from fundamentals. It has, in fact, been triggered by better growth that we saw in the back end of last year, and again, some strong data that we've seen in the start of this year. But it has snowballed into a more technical rally that has seen a squeeze in some of the least loved names. The question for us, and this is what we address in our outlook that we published this morning, Unfinished Business, is how that data is going to manifest in terms of central bank policy. And I think the risk that the equity market is not really priced for here is that stronger data in turn drives a more hawkish Fed that ultimately is going to be challenging for the equity market, indeed the economy, further down the line.
We've been talking with analyst after analyst who have changed their views on what's going to happen this year several times already in the first 2 months of the year. How have your views changed as we've gotten different data?
Yeah, so our equity market view is unchanged from where we are at the start of the year. We still expect to see a recession this year. Our economists have pushed that back 1 quarter from Q2 to Q3, but we actually now expect that recession to happen from a backdrop of even higher terminal rates. So the expectation from our economics team is that the Fed get to 5.75. So the issue we have for equity markets is when we look at things from a valuation perspective, we already have an equity risk premium, which is at multi-decade lows. If we are going to have a more hawkish reaction function from the Fed and ultimately a recession, as this tightening that we've seen, this very rapid pace of tightening over the last year feeds through into the real economy, then we think it creates a very difficult environment for the equity market in terms of valuations. And we think in terms of fundamentals, margin compression, we still think is coming. And that's going to be a very difficult backdrop to navigate.
Let's just quickly put some numbers on that, Greg, then. So you've got Carl Riccadonna over at 575 on Fed funds. You're on what on the S&P 500? 600 points lower?
Yeah, so we see the S&P troughing around 3,400. I think the big difference that we have in our U.S. equity forecast, and we've had this all year versus our peers, is what our peers have generally been looking for is some kind of trough, some kind of capitulation that sees the market trade down to low 3,000s. But then ultimately, many of our peers have the market then recovering and having a kind of strong back end of the year to kind of finish close to where we are now. The big difference in our forecast is that we see the market getting down to 3,400, but then potentially flatlining through the second half of the year. Because if we do get this recession that we're forecasting, we don't expect to get a super accommodative Fed and very easy monetary policy. We don't expect fiscal stimulus to help bail the market out. So we think we could get a very different type of equity reaction function to that kind of bear market capitulation than the V-shaped recovery that we saw almost 3 years ago.
Wow, some big calls there. Greg, thank you.
It was on the edge
Greg
of Brambo.
Boughton of BNP Paribas. Greg, what's that, 15% from here, downside?
I don't know. Lisa's still over there doing the math.
It's 16% downside from where we closed yesterday.
Wow. That's some real
She's
downside.
got a spark station.
575 from Carl Riccadonna on Fed funds.
This is where we are. We can talk about this coming back. Numbers and views. The narrative is shifting.
Got another view. Mike Wilson of Morgan Stanley, 8 a.m. Eastern Time, about an hour and 48 minutes from now. Don't miss that conversation. Future's just about positive. Chairman Powell coming up a little bit later this morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden will propose raising taxes on wealthy Americans to help avert a Medicare funding crisis. His plan would boost Medicare taxes from 3.8% to 5% on certain kinds of income above $400,000. It also would allow the government new power to negotiate drug prices for Medicare. Bloomberg has learned that more job cuts are on the way at Meta Platforms. The parent of Facebook will cut thousands of employees as soon as this week. Now, that follows a 13% reduction in November. Meta has seen a slowdown in advertising revenue and has shifted focus to a virtual reality platform called the Metaverse. The new foreign minister of China warns that the U.S. approach to Beijing is a reckless gamble. Qin Gang says the U.S. is trying to contain and suppress China and get the two countries locked in a zero-sum game. Now, he accused the U.S. of creating a crisis over Taiwan and criticized the use of sanctions in Russia's war in Ukraine. In France, unions are hoping to bring the country to a standstill in a 6th day of protests. They're demonstrating against President Emmanuel Macron's plan to raise the minimum retirement age. Transportation is likely to be severely disrupted. Only 1 of every 5 high-speed trains will be running. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We made a lot of progress, but there's so much more to do. When you respond to a fire, you don't leave until the fire's out. Well, I'm telling my colleagues, don't leave till we finish the job. We got more to do. I'm determined to finish the job.
The President of the United States there at the firefighters conference in the last 24 hours. Live from New York City this morning. Good morning to you all. Big day for Wall Street. Chairman Powell speaking a little bit later this morning at 10 a.m. Eastern Time in front of the Senate Banking Committee. Look out for that. Going into it, equity futures shaping up as follows. 3-day winning streak on the S&P 500. Believe it or not, the 3-day winning streak is the longest since early February. That's how dicey things have been over the last month. Equity futures right now up 8 points, positive 0.2%. Yields come in 2 or 3 basis points on a 10-year, still just short of 4% after reaching that milestone last week for the first time since November. Your 10-year right now, 392.84. Just on China, some really interesting comments through this morning from various officials, including Xi Jinping, but this from the foreign minister, who many of you will remember was the former Chinese ambassador to the United States. Here's the quote for you. The US claims that it seeks to outcompete China but does not seek conflict. Yet in reality, the so-called competition aims to contain and suppress China, Tom, in all respects, and get the two countries locked in a zero-sum game.
I don't know where it ends up. I really don't have a handle right now on it. I think it's important that the Speaker of the House, I believe, is going to meet Taiwan authorities in some form of America, whether it's Hawaii or the West Coast. Maybe he's not going to travel to Taiwan. It's very delicate now on multiple fronts.
Well, look at this language, Tom. The approach taken by Washington to Beijing is, quote, a reckless gamble with the stakes being the fundamental interest of the two peoples and even the future of humanity.
Well, they're taking
some pretty dramatic language there.
Yeah, that's dramatic language, and maybe it's lost in translation. But at the same time, this is a new China. More than anything, I would suggest it's a new China. It'll be something with us. Lisa?
Well, the official translation actually was watered down. And if you actually did the verbatim, that was the real fiery rhetoric. So I do wonder who they're talking to. And it raises a question of whether they're using the U.S. as kind of a political hot-button issue to try to garner support locally when there are a lot of issues facing that nation.
Exactly. Really well said. And I've also been told there's a lot of idiomatic phrases here where there's nuance in body language between the niceties where in English we translate it verbatim and maybe they don't.
Well, to be clear, US officials, a lot of the statements on China aren't for China either, right?
But that's
They're
exactly
for domestic
right.
consumption.
But that's a great point. How do you then bring two nations together that may have common ground but don't necessarily have a reason to express it publicly, given where the populations are?
Where we are right now on China. We're going to digress here with a brutal note this morning from Greg Valliere, widely read from AGF Investments, and it was shocking how he addressed what's going on in Ukraine. I would suggest it's beneath the headlines of happy talk in America. He harkens back to Leningrad of 1942, and far more the emotions of a 1-mile charge of the Confederacy, Pickett's charge at Gettysburg. Anne Marie Horton joins us now on Ukraine with a recent reporting, I should say, in Poland. Anne-Marie Horton, I was thunderstruck by Greg Valliere's use of history right now. It's not something trite like, is Bakhmut the new Gettysburg, but just what exactly is going on and the violence, the viciousness of this war?
Well, this is really the epicenter of the fighting and the most brutal fighting, as you mentioned, Tom, in eastern Ukraine. This is in the Donetsk region, and you really see all forces at play here. Zelensky was out last night saying no one will be abandoned in Ukraine, even though you do have a really proper offensive coming from the Russians. But you also have Defense Minister Shoigu talking about the fact that why Bakhmut is so important for the Russians. He's saying that this is a link of the Ukrainian defense forces. So if they're able to capture Bakhmut, it is really the only way they have to really maintain that control in eastern Ukraine. But the Russians are fighting also amongst themselves in the eastern part, specifically in Bakhmut. And you see this from Yevgeny Prigozhin of the Wagner Group saying to the Russian military, you're not giving us enough to succeed here. So potentially you could see the Ukrainians try to divide the Russians in this city. And this is one thing that a former Putin advisor was taking to Telegram and explaining to the world of some of the intricacies that's happening.
With your reporting and Maria Tadeo's, are the allies on the same page of the immediacy of supporting Zelensky and the Ukrainians?
I think they are at this point, and let's potentially see what happens on Friday, right? You have Ursula von der Leyen coming to the White House. This is on the heels of Olaf Scholz coming to the White House, and the United States is making it very clear that they want to continue to support and defend Ukraine to the very end. What you hear from Ukrainians time and time again, besides the ask for more weapons, right now, obviously, it's F-16s that are at the top of their agenda, is that they need sustainable renewals of ammunition. And this is really what it's come down to.
Hey, mate, we need to talk about what's happening at home. Last week, we talked about the C-suite in America, financial institutions being caught between blue states and red states. And what we're seeing more recently is not just the C-suite in America, the financial institutions, but also Walgreens. So last week it was about banks and whether they could do business with states like New York or whether they could do business with states like Texas based on their views on fossil fuels. This week it's about Walgreens and birth control. AMH, can you tell us what's happening with Walgreens, with California and Gavin Newsom, the governor there, and how this is going to look going forward?
Well, it's a great point, Jonathan, this back and forth between the blue states and the red states and how it's becoming incredibly difficult for corporate America to navigate. So last week, what you had Walgreens say is that they're not going to be selling this abortion pill in some 20 states because those attorney generals said that they will get sued because this is illegal in those states, following obviously what happened with Roe v. Wade. Now you have Governor Gavin Newsom of California saying that California, the state, will not do business with Walgreens because what Walgreens is doing in these red states. So corporate America is finding it very difficult at this moment to figure out, one, the laws and legality in some of these states, but also what the pushback will be from the other side. And this is just the latest in a string of, I'm sure, many to come, because these issues are really being politicized at the moment.
Are we asking corporate America, Anne-Marie, to choose between doing business with states like New York, states like California, or states like Texas?
I think from a state level, that is what you are seeing, whether or not it's a comptroller, attorney general, or governor. You are seeing these states basically telling companies that they have to choose. But from a federal level, that's not happening yet. But that's what it does feel like. They are feel like they are being pushed and pulled in either direction. And at some point, the problem is this is going to hurt everyday Americans, right? This is going to hurt, with this particular instance, when it comes to this abortion pill, this is and also just stopping business with Walgreens in general, this is going to come down to hurting everyday Americans. But I imagine there's going to be a lot of legal battles, Jonathan, when it comes to this decision in particular.
AMH, thank you. On the latest, Anne-Marie there. It's difficult to assess just how much business the state of California does with a company like Walgreens, Lisa, but clearly you can gauge the direction of travel here on several fronts.
You said last week, risk mitigation. That is going to be the issue for the C-suite. They want to basically reduce the risk. And if you have 21 attorneys general coming out and saying, if you do this, we're not going to allow you in our state, well, then the risk is to not sell in those states. What California is trying to do is to say on the other side, you know what, we're going to ban you if you don't sell this, which basically creates a quagmire of the ultimate size for a lot of the executives of these companies. Who do they cater to?
James Dimon, I think he loves Florida. Is he going to get wrapped up in this? Is big banking going to get wrapped up in this?
Unclear. I want to be very clear. It won't stop Walgreens from operating in California. It's about whether the state of California will do business with Walgreens. And that's the lever that states like Texas have to pull as well.
At a certain point, though, how does corporate America deal with a very polarized America?
Tremendously
I don't understand.
Difficult. Tremendously difficult. I mean, we sort of look down our nose about the red tape in Europe. Look what's developing here in the United States. Super, super hard to operate here with this as your backdrop. From New York, this is Bloomberg. Equity futures with just a little bit of a lift on the S&P 500, up a little more than 1/10% on the S&P. On the Nasdaq, up 1/4%. Greg Bowdle of BNP Paribas on the program 30 minutes ago. So the team over at BNP Carl Riccadonna, the chief economist there, is looking for 5.75 on Fed funds. That's the terminal rate, the peak they're looking for. And Greg thinks there's about 800 points of downside into year end on the S&P. Lisa did the maths. That's about 16% from the close yesterday. Lisa, that's some downside in the equity market. That's the call from BNP at least.
What drives it? What's the trigger for the reversal? Because we've already priced in higher rates. We've already priced in earnings expectations that are coming down. We've seen some margin compression, perhaps not as much as some people had expected. What's the trigger now?
5.75 and growth decelerates. That's the view, that this Fed has to take rates to the point where growth starts to get hurt. And I'm with you. To this point so far, we haven't seen that in a major way. They just don't believe clearly that the numbers we saw in January are going to carry on through the rest of this year.
I would suggest that there's a bet that we will have disinflation. It's still in the market now. Is it Ed Hyman disinflation? I don't know. David Rosenberg?
Well, it's not just disinflation, Tom. It's how you achieve that disinflation. Do you need growth to get absolutely hammered to achieve that disinflation?
In the scenario of the NASDAQ up 17%, make it 18% off the October low, is the growth slowdown is not all that much, and maybe the disinflation is not all that much.
It's also sequencing. It's a sequencing issue as well, because if you get declining growth, right, like you're saying, for the rest of the year, and then all of a sudden people say, well, wait a second, maybe inflation isn't so bad. Maybe we can actually expect it to go down more significantly. Then rates come in, and then all of a sudden you have the beginning of a new bull cycle. I mean, this is what you get the bulls arguing, that it basically takes the pressure off the Fed and accelerates some sort of pause.
I'd suggest if you've got that backdrop, there'd be a lot of people screaming earnings will be absolutely dreadful against the backdrop of growth decelerating, inflation rolling over, and rates still in and around 550. Can you get bullish earnings on that? That's hard.
It's hard, especially when you've already had some negative surprises, and yet there still is this optimism.
I want to get to the bond market as well. Let's look at 2s, 10s and 30s. Your 2-year looks a little something like this. 485.48 after going through 490 last week. Your 10-year 392.84 after having a look at 4% last week. At one point last week, 2s out to 30s, the whole curve was 4% plus. And now we've got a 30-year back to about 386. Just to run you through the next couple of days, Chairman Powell is later in front of the Senate Banking Committee at 10 a.m. Eastern Time. Then after that, you're going to see Powell in front of the House Financial Services Committee tomorrow. Then it's on to payrolls on Friday and CPI next week as well. CPI on the 14th falls in a quiet period for the Fed, so it's not like they can all come out and talk about what they think they should do off the back of CPI, Tom. So the Fed speak ends at the end of this week.
We're going to get a brief now. Alan Russ going to join us here in a moment. First, Michael McKee is in Washington, our international economics and policy correspondent here, waiting for what we're going to see in the Sherrod Brown, Tim Scott, Jerome Powell derby. Mike, you and I are the only two within the Beltway that still call it Humphrey Hawkins' testimony. How will this be different than the other gazillion before when he's up against Brown of Ohio and Scott of the South?
Well, it won't be significantly different because every hearing that the Fed chair attends is an effort by members of the Republican and Democratic parties to get him on their side. There is going to be some dispute about how far the Fed has to go and whether or not they are going to be sacrificing Americans' jobs in the cause of bringing down inflation. I would add to your list, Tom, Elizabeth Warren, who's been very outspoken about this. We should hear from her on that. One thing we haven't talked about, because we've been so focused on whether or not he'll say interest rates are going up, is the debt ceiling and the idea that we might see a government shutdown come October. I'm sure those topics will come up, and he'll be asked to take sides, and he will do his best to avoid doing that.
Who is opposite of the senator from Massachusetts? Who is the Republican that is the opposite of Warren?
Well, probably any of them would take the view that the inflation rate is something that needs to come down. Nobody's going to endorse losing jobs, but they will point out that the unemployment rate is 3.4%. And so inflation takes a toll on everybody, including the lowest paid. And so the primary goal of the Fed should be to bring that down. Fed argument is we've gone from zero to 475 basis points, 4.75% in a year, and we are not seeing the economy slow. So we have to go higher. We've only taken away accommodation at this point. It really hasn't hit the idea of some sort of effort to slow the economy. That hasn't happened yet. We haven't gotten restrictive, so we may have to go a little bit further.
Michael McKee, thank you so much. Greatly appreciated this morning, and much more coverage from Mr. McKee as we hear from the chairman. Look for that on Bloomberg Radio and Bloomberg Television this morning. He is with Deutsche Bank, and they have absolutely nailed the recession delay called. There's no other way to put it. Out front on it, Alan Ruskin joins us now, their chief international strategist. Alan, to get started, and I got 8 ways to go here, let me talk to you about one of your glide paths, which is, as I mentioned to John earlier, we don't get the outright disinflation back to the romance of 3 or dare I say 2%, but we get back to moderately inflated. Then what?
Then we have a problem, Tom, because Fed credibility, I think, is really on edge. I think they're committed to that 2% inflation target. And if it looks like it's not achievable, then, well, eventually you'd expect that they'd have to raise the target or alternatively place much more additional pressure, downside pressure on inflation. And I think it's the latter course of action that is the first course of action, that they would just tighten up that much more, really, in a way. So it really means probably a higher terminal rate and greater risk of a recession. And, ultimately, inflation does come down.
There's been a feeling that as inflation comes down and as we see recession calls start to loom more seriously and more significantly, perhaps more imminently, that you're going to see the long end of the yield curve come in and stabilize. And yet your colleague George Saravelos was talking about the Bank of Japan and how they're actually going to see 2% inflation and they're going to raise rates more significantly. How does that translate to a view of longer-term U.S. debt?
Yeah, look, I think the Japanese role in funding the U.S. Fiscal deficit and the current account deficit is much exaggerated. Japan has not been a major player for some time now in terms of portfolio flows, so I wouldn't worry on that score. I think what is going to be very interesting is that you could build into a scenario, and it feels at least as much the end of this year or 2024 story, where you start to think in terms of the Fed rate cycle turning over and the Japanese rate cycle just beginning. And that makes, obviously, for a much stronger yen. I think the market has maybe been a little bit premature in thinking in those terms. Obviously, yen appreciated quite sharply towards the end of last year. It's performed less well recently. But I think there is that scenario out there towards the end of this year where you have this disjuncture between the BOJ and the Fed that could actually be very, very helpful from a yen exchange rate standpoint. But I would not suggest that, just because the Japanese might be buying somewhat less in the way of U.S. debt, that U.S. yields are going to be much higher because of that.
I mentioned the Bank of Japan because Friday is Kuroda's last meeting, and where people are assuming that you're going to get some peaceful transfer of the regime, the monetary regime that he has overseen. Where does the next disruption come from, Alan, especially as we look out to this idea of the reopening trade in China, possibly already having run its course, and this feeling of disinflation that now is just a question mark?
Yeah, look, I think Japan is still a potential source of market disjuncture in so much as the BOJ's tried to prime the market and allow the market to effectively get out of some unhealthy long bond positions. But there's all the possibility that eventually JGB yields, 10-year yields jump substantially. And you could envisage that, full normalization. You could even have, a 10-year JGB yield climbing from, say, 1.5 to into the 2s kind of thing, and a long-run equilibrium rate in terms of short-term rates at 2% were the BOJ to get into a proper tightening cycle. So it still feels to me like there's a lot of room for disruption from the BOJ standpoint. I don't think that's the story for the next, at least for the next month or so. Right now, I think we're focused much closer to home.
Alan, how do we make central bank boring again? How do we do that with balance sheets this big?
Sorry, how do we make
central banking boring again? Central bank policy is just completely dominated and taken over for much of the last decade. How do we get back to the old days?
Look, I think these maybe are the old days, right? The old days are a sense of change in terms of short-term rates, a sense in which rates are well above zero, and interest rate differentials do drive currencies and create volatility. I think we're, in fact, sort of to some extent normalizing. And if anything, I think we're going to come out of this cycle with an equilibrium interest rate that is definitely higher than it was pre-COVID. So in that sense, I think this is actually a return to the old normal, as it were.
Anna Ruskin at Deutsche Bank. Anna, thank you. Those balance sheets, Lisa, they look normal to you?
Well, and if they don't look normal, which they don't because it's $8 trillion in the U.S. and all around the world, if you take a look, we've actually had quantitative easing over the past year, not quantitative tightening.
Yeah.
There's a question of, well, do we go back to smaller balance sheets? Do we shrink them? Or do we just sort of let this be the new normal amid a backdrop of boring central bank policy?
I'd love for it to be boring again. Can you imagine the disruption of Japan trying to really unwind that balance sheet?
So here's the thing. Alan Ruskin was saying he doesn't think that the Japanese really fund the account deficit for the U.S., so it wouldn't have as big of an effect on Treasury yields. I don't know. I mean, honestly, this has been one of the big tail risks, people seeing the potential for 10-year Treasury yields going over 5% if Japanese buyers suddenly have 1.5% to 2% yields on 10-year JGBs.
I like how you described it, the peaceful transfer of power, Tom, from one central banker to another. Like that's where, that's where we're at now. That's where we're at.
I've been thinking about this the last couple of days, and that you're going to get back to what we remember 20 years ago, which is to daily calculate where the U.S. 10-year should be, but it's not because foreigners have bid up the price, bringing the yield in a little bit. We haven't really had that conversation for 2 decades. It's going to be a delta of a quarter-point yield, half-point yield, 3/4. It's huge.
The 10-year right now in Japan just short of 50 basis points balance right. Ultimately, that would mean some major changes down the road. We'll talk about that later in the week. What is it, March 10th?
Yeah.
For Governor Kuroda.
Last meeting.
Last meeting. Wow, 10 years has gone by fast.
And It's been a transformative 10 years.
Futures positive 0.2. This is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. The job cuts aren't over at Facebook parent Meta Platforms. Bloomberg's learned the company is planning a new round of layoffs and will cut thousands of employees as soon as this week. In November, Meta eliminated 11,000 jobs, 13% of its workforce. Taiwan's President Tsai Ing-wen reportedly persuaded House Speaker Kevin McCarthy to meet in the U.S. due to security concerns. According to the Financial Times, Tsai's government shared intelligence with McCarthy about threats posed by China. McCarthy has said he wanted to visit Taiwan at some point. The powerful sister of North Korean leader Kim Jong-un has issued a new warning to the U.S. and South Korea. Kim Yo-jong is threatening severe consequences if the two countries go ahead with joint military drills next month. Last month, North Korea threatened to turn the Pacific Ocean into a firing range if the exercises took place. President Biden is reportedly considering reinstating the detention of migrant families who cross the border illegally as his administration prepares for the end of Title 42. According to the New York Times, no final decision has been made. The more restrictive measures would be a reversal for the president, who wanted a more humane immigration system. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The thing I worry the most about is Ukraine. It's oil, gas, the leadership of the world, and our relationship with China. I mean, that is much more serious than the economic vibrations we all have to deal with on a day-to-day basis.
Always good to hear from Jamie Dimon, the JP Morgan Chase chairman and CEO on Bloomberg TV and on Bloomberg Radio. Equity futures right now on the S&P positive a little more than 0.1% on the S&P 500. 3-day winning streak on the S&P 500. Can we make it 4? 3 days, believe it or not, the longest since early February. I keep saying that because I can't believe it. It's been a month and change since we put together 3 days of gains on the S&P 500. Yields down about 3 basis points. Your 10-year 392.45 as we all count down to Chairman Powell a little bit later this morning, 10 a.m. Eastern Time, in front of the Senate Banking Committee, Tom. Then it's on to Wednesday in front of the House Financial Services Committee, and then it's on to Friday, really. It's about the data. It's payrolls
and that's
just
what
around the corner.
He's going to tell them. He's going to tell these people, whatever their angle is, whatever, as you mentioned, John, the fill moment they want to get with the chairman, he's going to say, you know, I'm waiting for the data. You should too. I don't think politicians want to wait for the data. They're worried about what happens tonight at dinner.
I don't think people in markets want to wait for the data.
I think there's a lot of that going on, and this is the ex post reality for every central bank.
Is he open to a bigger move at the next meeting if indeed this February data that comes in on Friday confirms what we saw in January? I'm not saying 500,000, but I'm saying 300 plus on payrolls. Does that encourage a bigger move?
No, I'm not going to give you my opinion. No one cares. But I will say the following. Without question, on a risk basis, to be measured gives you less error than to be jumpy. We went to silence there. Is that?
But we just thought you had more to say.
My opinion.
No, we just thought you had more to say. You're finished. Okay, I didn't know you were
I'm not finished. I'm just saying Greenspan invented measure because he was risk averse.
Yeah.
And Powell's no different. I mean, it's all there's to it. Let's jump to this and say the segment because this could be my last interview with Bloomberg. Lupin Rahman joins us on. We are thrilled to have her back, really to begin our coverage of what the International Monetary Fund will be doing here 1 month out. We're making a lot of good plans on it. John Ferro leading our planning meetings on IMF spring meetings. Lupin Rahman is with PIMCO and is well versed on the emerging markets. Look, but let's start with the beginning. To me, there's 2 EMs at the minimum, the frontier economies, greatly beleaguered, and another EM of great prosperity. Or dare I say, could there be 3 worlds of EM? Which is it?
I think EM is extremely diversified right now, and you hit the nail on the head in terms of bifurcating the frontier economies, especially the low single B high yield economies that are facing a lot of stress. Some of them have very large external financing needs. They're having to have IMF programs or other bilateral lines from creditors like the Gulf states and China. And then there is the rest of EM. There is the investment grade portion and the double B portion of the EM asset class. Even there's a lot of diversification and differentiation, both in terms of the balance sheets as well as how these economies are coming out of this COVID and growth cycle.
Do you look at this as country by country or by asset class or even subsets of asset class?
You have to look at all, unfortunately. I don't think EM is a one-size-fits-all in terms of the framework or model that you need to use. And so, really thinking about asset classes and regions makes a lot of sense right now, as well as countries that perhaps are going to benefit more secularly from the nearshoring and structural shifts that are occurring both in the global and macro playing field for EM.
Lupin, I was reading this morning all of the rhetoric, the fiery rhetoric coming from the Chinese Communist Party, coming from leaders talking about the increasingly fractious relationship between the U.S. and China. I hear the same coming from a lot of U.S. officials. What's the investment consequence of this? Because right now I'm still seeing a lot of people say Chinese debt, Chinese equities, they're a buy.
I think the main investment implication from this is to really think about EM in terms of the various centers of global growth and drivers of global growth. For EM as a whole, this fractionalization that we're seeing much more of from the US and China trade relations and geopolitics is really going to be a headwind for many countries within the asset class. Slow globalization, as the IMF has coined the term, is not a positive for the EM asset class as a whole. Having said that, there are areas that are going to be growing and perhaps benefiting from this. Countries like Mexico, countries like India, many other smaller emerging markets that perhaps have a niche in particular parts of the supply chain. And so for the EM asset class, I think the investment implication really is to start from the bottom up and really focus on country by country selection in terms of really thinking about the investment opportunities that are out there.
Specifically with China, I think about Mark Mobius, the emerging markets investor, who complained that he had some money in China that he couldn't get out because of all of the red tape that he had to go through to bring the money out of the country. In your view, is China not uninvestable, but increasingly a fraught investing proposition that perhaps isn't recognized in pricing currently?
Well, I think that, looking at the fixed income opportunities in China over the cyclical horizon, we are a bit more cautious given the opportunities elsewhere within the fixed income world as well as within emerging markets. So if you're looking at the level of real rates, really you're getting better opportunities elsewhere, whether it's Brazil or even Mexico. If you're looking at currency plays, perhaps the CNY is not the best play right now, given with outbound tourism, you may see capital outflows resuming. So I think that from an investment perspective, there are more interesting opportunities from a risk-adjusted perspective elsewhere within EM.
Lupin Rahman of PIMCO. Lupin, thank you. On EM, China, and whether it's investable or not, when you saw the reopening, I think everyone, Lisa, piled onto the idea it is now. And we saw Chinese tech stocks absolutely rip. You pointed out yesterday off the back of this, and not my language, other people's, disappointing Chinese growth target. Let's call it modest at 5% as this economy snapped back. Does that open the door then to a little bit more fiddling, some regulatory moves from the Chinese leader?
I had to wonder about that, especially as we read about some of the changes to the structure of the government overnight. They took some people out of sort of the main bucket, and then they took them and put them into higher regulation for the financial industry, more data oversight, sort of tightening the screws of the corporate existence in China at a time when that balance between the economic side of things and the social side of things is changing.
I think it's really well said in that I don't understand the triangle of Beijing, the so-called SOE, the state-owned enterprises in private corporations in China. Tom Orlick has been with me twice here in the last couple of days. I just don't get it. I just don't get where that newness is right now. Business at hand, we need to say thank you to all of you on radio and television for a massive response. Yes, it's time for a victory lap. We're going to do that with Jonathan Ferro.
We're doing a 2-minute victory lap.
Formula One guy. 2-minute victory lap. We're going to break the champagne out and start spraying each other. And the answer here is, John, that was a lot of fun yesterday with the gentleman from Red Bull.
It was cool, wasn't it? He's very smart. Used to be a driver.
I got lots of emails say, ask John, why are they so good? And I always ended up with the guy he turned to at his left during the race, Adrian Newey. This guy makes $9, $10, $12 million a year.
Designs the cars.
Nobody knows who he is.
Well, if you follow Formula One, you know who he is. But he designs the cars. Genius. Absolute genius.
This guy, and he started with Emerson Fittipaldi years and years ago. He's done this for years. But what does he do? I mean, it's not just tweaking the engine and all that. It's all the airflow, right?
That's the airflow stuff. Yeah. It's the stuff that you know more about.
Why do they know than Mercedes? What? I mean, I don't get why they have an edge over 10 other teams.
Don't know, but they lost some important people on that front to Aston Martin.
Because everybody wants to buy Red Bull.
Everyone wants a piece of that. It's a talent acquisition over the winter.
I have a question about that interview. The Kardashianization of Formula One, is that for America, or is that also something that plays in Europe?
No, I think it's for Europe too. Okay. And it's about going beyond just, say, a male-dominated motorhead audience. He talked about diversifying the audience. He talked about that twice. Not just geographically, but the types of people that would follow the sport that wouldn't traditionally follow the sport. I think it's important that you got to know the drivers not just at the front of the grid, but also at the back of the grid, because sometimes those races can be tremendously boring. And I think if you didn't have the interest in the people further down the grid on a race like Sunday, you would have looked at that, saw Max Verstappen 2 miles up the road and thought, why do I want to watch this? But when you've got an interest in what the other guys are doing...
Right. Well, and a lot of the sort of descriptions of Max Verstappen was he was clinical about his win almost. But I will say, as a woman, I find the mechanical stuff fascinating, basically driving a jet engine.
Well,
on the road.
we're in Jeddah in 3 weeks, and it'll be interesting to see. I mean, the Saudi course is radically different than Bahrain.
Are we going to Jeddah?
I can't even say it with a straight face.
Have you got that signed off?
I am. I talked to Red Keeper of the Amex, and I said, we'll cover oil.
Features positive here, 0.1%. Chairman Powell, a few hours away.
Our core view is still one where you're going to see economic growth resilience.
Yield curve is a very powerful signal that we might be seeing a very big slowdown in the economy.
I'm not sure that disinflation the market was really grabbing onto at the start of the year is necessarily going to come through.
Over the second half of this year, you are going to see the consumer pause.
I think that markets are trying to sort of, frankly, start ignoring 2023. I think people are ready to get past it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Coming up on Capitol Hill, the most powerful man in financial markets worldwide, Chairman Powell, a little bit later this morning on Capitol Hill, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Equity futures up by a little more than 0.1% on the S&P 500. TK, it's over to you. Jay Powell, a little bit later.
Jay Powell, be interesting, always interesting in the two testimonies. I'm sorry, old fogey, that's Humphrey Hawkins. And the answer is the Senate will be more collegial. Even the senator from Massachusetts will speak with grace, less yelling and screaming. And then at the House tomorrow, I think you'll see a lot more emotion.
Andrew Hollenhorst, the city, says it comes down to this. Perhaps the hawkish or dovish takeaway may instead depend on how strongly he endorses the path of hikes now priced. What are we looking at right now, Lisa? 540?
7.
Yeah, 550. Almost 550,
maybe.
basically.
Let's see what Friday brings.
Exactly. Well, 550, and it's been hovering around there, 440 to 550 by September. So how does he endorse it? This is my question. What is he looking for, and how long could they hold rates at that level? To me, how much does he express concern about the fact that inflation data and employment data has come in hotter than people have expected for many consecutive readings?
If we just said what you just said a year ago, 99% of our audience would say Dow 20,000, S&P 3,000, 2,800. Why are equities up with this spike in yields?
I think we should frame where we were 12 months ago as well, Tom. Still doing QE coming into March, rates at 0. I think if someone had said 540 and you laughed and joked about 7 and some people scratched their head, well, maybe 6 plus.
Yes.
12 months ago, that was kind of unthinkable.
Right.
Lisa.
It was a far-fetched idea. Now people are saying, well, if you actually follow the Phillips curve, we could get to 8. I mean, you have people gaming this out based on different models. The point is, we're in a different reality, and even with yields where they are, even still, inflation is surprised to the upside. So are we going to hear about long and variable lags today? Are we going to hear about just trying to break something? Are we going to hear about financial conditions and his concern about the fact that stocks are so resilient?
Long and variable lags. No,
he's not.
Long and variable lags was Team Mercedes at Bahrain.
Yeah, there were some long and variable lags.
Yeah,
there were some very long lags.
Long and variable lags.
Some 2-minute lags, which in central bank speak is like 2 years. Anyway, equity futures right now, positive 0.1%. Let's whip through this just briefly. 3-day winning streak into Tuesday. You hear from the chairman in about 3 hours from now. Lisa will give you the times of everything in just a moment. Yields come in a couple of basis points. Your 10-year 393.43, euro dollar 106.56. We're negative 0.2%. I do want to talk about some ECB speak a little bit later because, Lisa, we've heard from so many hawkish voices in the last day or so.
Yeah, ECB's Holtzman coming out and expecting that perhaps we could get to 4.25 on the ECB main rate. Just sort of unfathomable based on where we have been in that region. Here's what we're watching. 8 a.m. we talk with Mike Wilson of Morgan Stanley, the chief U.S. equity strategist there, about Tom's question. Why aren't stocks reflecting what we had expected they would do in the face of rates that are much higher? Why have we not seen a reality between the fundamentals and the price action, or are we, right? And so we've talked from Greg Bottle over at BNP Paribas, and he was saying he could see a 16% downside in equities. I think Mike Wilson is sympathetic with that view. What could make him change it? At 10 a.m., we hear from Fed Chair Jay Powell. He is testifying ahead of the Senate Banking Committee, as John and Tom are talking about. 9 a.m. we get the comments released ahead of it, so perhaps we'll get some indication of where he plans to go, or maybe it'll just be some sort of antiseptic comment that gives him leeway to say whatever he wants. And at 3 p.m. we get U.S. consumer credit.
Are people still borrowing to spend? You know, and this to me is one of the main questions. How much more dynamism is there left in the consumer spending engine that has fueled U.S. economic growth, that has fueled some of the inflation that we see in services in particular? Is there a beginning of some sort of restraint, especially as rates go up and as people get a little bit more concerned about what's to come, John?
Elisa, thank you. Let's get straight to it in the equity market. Anna Han, equity strategist at Wells Fargo Securities, joins us now. Anna, always wonderful to catch up with you and good to see you. I want to start with that line you started the week with over at Chris Harvey and Wells Fargo. Do not trade as if we're in a bear market. We're not. Anna, what does that mean?
Well, we spoke about earlier this year how there was a fear of the bear market, another repeat of 2022. But to us, we don't see those same signs. The Fed has slowed down considerably. Credit markets stay healthy. The consumer continues to spend, and wages are continue staying strong. This is not the signs of a typical bear market. At the same time, we're not expecting this massive bull rally either because we don't quite see the catalyst there. So rather than trading fearfully and too defensively, we're still on the offense here looking for opportunities in the equity market.
So, Anna, just to be clear, this is another way of saying October was the low for you. That was the low.
We won't say it's the ultimate low. We do think that equities can drop lower, but for us, it would take a lot to see those October lows again. It would have to be a quite extreme case. And part of that right now, we don't see it lining up that way. Now, you know, we always love to talk about tail risks, but our base case scenario is that in the near term, we see more upside for equities.
And I want to go away from your quantitative analysis and go to what you think's fundamentally going to happen in corporations. I know your love for Team Mercedes and you, Louis and George, just want to go faster. Are corporations going to be able to go faster given high interest rates? Are they going to adapt and adjust constructively?
I think they're still going through those growing pains right now, and they're really wondering if the consumer starts to weaken, can they make those changes effectively and in time? So for us right now, what they're showing is that they're passing along price. They continue to, but almost across every industry, except for a very select few, you are seeing that volumes are down, and that price elasticity is really biting into margins consecutively quarter over quarter.
This is brilliant. I want to talk to you about the elasticity of profit-making, free cash flow, stocks, really, you know, I know you like mid-cap growth a lot, but there just seems to be a massive skew in the market. I'm using that as a general phrase, a massive skew between those making money, the haves, and many, many others, the have-nots. Is that how you see it?
Well, there is certain extremes. You are seeing those industries, especially now that we are a couple years out of the pandemic, they're not so much that stay-at-home trade. We've also seen structural changes in people's preferences now coming out of the pandemic. Not as many people working full-time in the office. These structural changes, again, need time for corporates to really swallow and learn and grow from that. At the same time, even with slowing earnings and corporate growth, we are seeing positives for the equity markets because we continue to see that in the yields market that people continue to believe in growth. You're seeing real yields continue to go higher even as inflation expectations are repricing. So these are the kind of good and the bad things you're seeing that you mentioned.
So where does this shake out in terms of what the ramifications will be for equities going forward as we see rates perhaps go higher and stay there? Are you on the Greg Bowdle idea of things where you could see perhaps 3,400 in the S&P, or are you saying that we basically aren't going to retrace that much? We're basically seeing a new reality and people have adapted and adjusted.
Lisa, I think that 3,400 you mentioned, you need to see some sort of shock to the system. You need to see some very spiking in credit spreads or in yields. And you need to see a spike in inflation readings or a aggressive drop in the labor market. And right now, that's not our base case scenario, something we certainly are cautious of. And we're looking left and right and watching all the indicators for. We're not quite seeing it. So in the near term, we think actually things line up a little more positively for the equity market. But for that to continue, we really need to see that as inflation expectations continue to remain sticky, that still gives the Fed a little more room not to overdo it. And we see Fed communication continue. These are all the things we want to see persist. And that persistence and consistency is what's going to make us feel better and more encouraged about equity investing.
Let's build on that. Today at 10 a.m., we're going to hear from Fed Chair Jay Powell. I misspoke earlier. We are not going to be hearing at 9 a.m. that sneak peek. We were going to get it released at 10 a.m. And I'm wondering if there is anything that he could say that would make you really rethink your more positive tilt. Is there something in particular that you're looking to understand more directly that you don't have a full handle on yet?
I would say consensus-wise, you've heard a lot about the 6%. Suddenly the sentiment on Fed funds and where they could go with the terminal rate. If Chairman Powell comes out and says something overly aggressive, which we think is unlikely, but potentially something could be interpreted as confirming that 6%. I think that could be quite shocking to the equity markets. That's unlikely, but again, something that we consider if we're talking about tail risks. On the other hand, if Chairman Powell comes out quite dovish, that could also encourage the market to flip back towards retreating yields, or if we see again at the end of this week the labor market signs, or if we see next week's CPI print, all these together are showing a mixed message rather than a coherent and same direction message. I think these are the things that the market is going to have to reprice and churn a bit for.
It's not a bear market. That's the call from Wells Fargo and the team, including Anna Had. Anna, thanks for that, as always. We mentioned it in the last couple of days, last couple of weeks. We've had 2 years and 2 months. January and February, radically different. Of course, the change that we saw in February was off the back of the payrolls data, then CPI, then retail sales, then all of the above. And Tom, we're going to get another sneak peek of February now in the March data that gets released.
And what's important here is adults, like I think Torsten Slok at Apollo, writing daily and in the morning, he comes out with the Goldilocks 3 scenarios now. I'm not saying he's optimistic, but he's looking at hard, soft, or no landing. I can't remember a time where adults like Anna Hahn in math and physics, or Torsten Slok with all of his great skills, are so narrative driven. We're making jokes about Goldilocks, but I don't remember this in the past.
If you take a look at some of the reports recently that have come out about quantitative trading and how much that's taken over, and how you're seeing individual bond and stock traders kind of pull back, stock traders in particular, people are saying perhaps that trend following momentum type of strategy is kind of driving the narrative more than anything else.
Marco of JP Morgan, Marco Kalanovic, spoke to some of this. He said this yesterday. While the day-to-day interplay of investors, speculators, the options market, systematic investors, etc., can produce strong rallies, we maintain their view. The risk assets are in a bear market and will not bottom until central banks start cutting rates. Get a Mike Wilson view on this over at Morgan Stanley in about 50 minutes from now. Looking forward to that as we count you down to testimony from Chairman Powell in front of the Senate Banking Committee at 10 a.m. Eastern Time. Futures positive, a little more than 0.1%. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden will propose raising taxes on wealthy Americans to help avert a Medicare funding crisis. His plan would boost Medicare taxes from 3.8% to 5% on certain kinds of income above $400,000. Now, it also would allow the government new power to negotiate drug prices for Medicare. Bloomberg has learned that more job cuts are on the way at Meta Platforms. The parent of Facebook will cut thousands of employees as soon as this week. Now, that follows a 13% reduction in November. Meta has seen a slowdown in advertising revenue and has shifted focus to a virtual reality platform called the Metaverse. China is shaking up oversight of its technology sector in the wake of a tech battle with the U.S. A national bureau will now manage and police data resources while building up China's digital planning. Meanwhile, the Ministry of Science and Technology will be strengthened to formulate strategic policies and orchestrate nationwide initiatives. Bloomberg's learned that Deutsche Bahn has selected Goldman Sachs and Morgan Stanley to advise on the sale of its DB Schenker logistics unit. A sale could fetch up to $21 billion. The German railroad operator is trying to slash debt and modernize its domestic operations. The Justice Department is expected to file an antitrust lawsuit this week to stop JetBlue's $3.8 billion takeover of Spirit Airlines. That suit is likely to claim that the takeover would harm flyers by leading to fewer choices and higher fares. Meanwhile, the Department of Transportation will try to block the transfer of Spirit's airline operating certificate. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
There has been quite a hawkish tone coming from the Federal Reserve. We'll hear a little bit more about that in due time. And, of course, from the ECB as well. One of the things about changing the target is it's a challenge when you change the target when you're below it. It's also probably a bigger challenge when you change the target when you're above it.
Catherine Mann there, of the Bank of England MPC, the Monetary Policy Committee member, catching up with Bloomberg's Francine Lacqua a little bit early this morning. Fantastic conversation, Tom. We've known Catherine Mann a long, long time, from Citi back to the days of the OECD, and TK even further back than that. It's been amazing to see her transform into a real hawk on the MPC at the Bank of England.
People that know Dr. Mann are no surprise to that, the rigor from Massachusetts Institute of Technology. What's great about Kathy Mann is, John, to be excellent in one world scope of economics, like trade is one thing. She owns the high ground on 2 points. One is the trade, or classic book, is the trade deficit sustainable, which was hugely influential at the time. But the other, which is hugely timely, and she can't comment on it, is she is the expert on the codependency of America with China. This is something she and Michael Rosenberg minted, and she can't talk about that because of the position she's in.
You mean she can't talk about TikTok now?
Yeah,
like that, wouldn't we?
Well, you know, she can't talk about all of it. Catherine Mann of the Bank of England. Maybe we'll get to see her the next time we're in.
Very cool.
Francine Lacqua killing that here this morning. Right now, our chief Washington correspondent, Amory Horton, joins us. Amory, it's real simple. Republican, Democrat, everybody inside the Beltway knows there's only one relationship. Interest rates go up. The interest on our debt goes up as well. The wonderful Peter G. Peterson Foundation codifying this for us in February. How grim is it? Rates are up. How bad is the interest that we pay on our debt?
Well, a lot of people are complaining, obviously, if they're buying a new home and their interest on their mortgages and their house. I mean, this will become front and center today, obviously, as Powell's going to testify ahead of the Senate Banking Committee, and then, of course, tomorrow at the House. There's going to be a lot of, the lawmakers will try to politicize everything he says, right? So whether or not it's rates, about employment, about inflation, potentially about his number 2 pick that we're waiting for the Biden administration to announce. This is going to be a moment where likely Powell's going to have to also say, I'm waiting to see more of the data. But it's going to be a difficult one for him, but maybe not as difficult as his last appearance. That was June of 2022, and inflation was almost at 9%. So this potentially may be a little bit of an easier one for him.
But net interests are going to rise. CBO, has got out 10 articles that talk about the mathematics behind the politics of the budget as well. Is anybody down there actually reading what the CBO is putting out?
I think a lot of lawmakers are reading what the CBO is putting out. I mean, we're going to hear what the president has to say about his budget on Thursday. But already you have behind the scenes everyone working on the budget for the next fiscal year. But let's see what Powell has to say. But Tom, all of this is getting politicized, right? Of course, the Fed decisions and whether or not you're on the Republican side or the Democratic side.
This is the Senate Banking Committee. I want to talk about the Senate Intelligence Committee, the chairman, Mark Warner, who's set to unveil a bill today that the administration may well support. And it involves TikTok. They may not name it directly. Anne-Marie, what's going to be in that bill?
Yeah, just another TikTok bill. There's a slew of them, but this one is interesting because it does look like the White House may throw its support behind it. What this would do is really extend this executive order under the Trump administration that gives more of this leeway to the Commerce Department to go after some of these technologies. So this would really put it in the hands of the Commerce Department, while the one that got through, Jonathan, the other bill through the House Foreign Affairs Committee, shepherded through by Mr. McCall of Texas, that one would allow the president to ban it outright. But notably, this does not name TikTok by name, but a lot of these bills don't name TikTok by name, but it gives either the president, the Commerce Department, this authority to go after TikTok. But under the surface, we have to remember, TikTok right now is in negotiations with CFIUS. It is looking into this with the U.S. government, and TikTok is really racing against the clock to try to prove and come up with this plan called Project Texas that they can isolate U.S. user data and make sure it is safe because they want to maintain in America and continue to operate in this country.
We talk about trying to create some sort of middle ground among the two polarized Americas, but I wonder, not just with respect to Republicans and Democrats, but within the Democratic Party as well, how much is perhaps some of the unity around issues surrounding China masking some of the increasing fissures, particularly for President Biden when it comes to the crime bill in Washington, D.C., and some of his social policies of late?
Well, so the crime bill has been a lot of pushback, right? Because Biden said that basically he's going to side with the Republicans. And in D.C. at the moment, you have the D.C. Council actually try to withdraw the crime bill. They don't want it to come to a vote to a Senate. So this has gotten messy. And there are some Democratic issues that have gotten messy for the president and infighting. But you make a good point, Lisa, whether or not you're in the Democratic Party, you're in the Republican Party, China is this constant thread in Washington that just absolutely unites the forces within parties and also across aisles. This is something where everyone seems to agree that more needs to be done. But clearly, the Biden administration at the G20 in Bali was trying to put this floor and, quote, guardrails on the relationship. And what did we hear from the foreign minister today, who's very well known, Qin Gang, is very well known in Washington, D.C., because he was the former ambassador. And he's really explicitly taking aim at the U.S., saying that what they are trying to do is encroach on China and make this relationship worse. So this is going to become much more difficult for the White House to deal with as they try to put guardrails on China while they're being really pushed to a hawkish stance from Congress.
It's especially difficult when, if they ban TikTok, you enrage an entire generation of Americans. I mean, I wonder, realistically, could they ban TikTok if basically the children in their home and potential voters are like, we just want to dance? I mean, honestly, I just wonder how much that will play to a tone-deaf kind of audience, even if it sounds good on paper and if it's justified by some of the data concerns.
It's a great question. When you talk to lawmakers about TikTok, I mean, Secretary of Commerce Gina Raimondo recently talked about this. If they have access to anyone under 30, they know that this could potentially be a very difficult decision, especially as you gear up for 2024 and you try to want to embrace the youth to come out and vote for you. It's potentially why politicians and the U.S. government may end up striking a deal with TikTok that's going to partner with Oracle to make sure they can isolate some of this data. But I think if you have a child at home that uses TikTok, you're not liked at home if maybe you're liked in Washington, D.C.
MH, thank you. I mean, what a ridiculous moment. That right
Parental
there
advice
describes the difference between an authoritarian country like China, who couldn't care less because there is no vote, and the US, a democracy that is worried about real intelligence risk around a social media company, but at the same time is worried about the youth turnout. What? I mean, that is bizarre. That is beyond ridiculous. If you truly believe it's an intelligence threat, then the fact that 20-year-olds might not come out and vote should not be part of the question at all.
You could just see the sort of modern-day version of Footloose, right? You know, we just want to dance. We want to do our TikTok dances, you know, and you're just going to try to shut it down.
What movie?
But you've never seen...
Never mind, Bramo, carry on.
You're going to do that to me. No, it's a good point, right? I mean, how do you sort of bridge what's been accepted norm in our society at this point? And entire social structures have been kind of built up around this. How do you then say, get it out?
And that's before we get to the issue of reciprocity. You know, could US tech firms get the same access to the mainland? I'm sure many of them would like to.
I would guess that some of the other social media companies would be very happy if the US were to ban TikTok.
Snap?
Yeah, exactly.
Snap the last couple of days,
yeah.
You mentioned crime in D.C. You've seen the carjacking problem in Washington, D.C.?
And this is what the crime bill was trying to target.
Amazing.
Yeah.
It's been climbing for 5 straight years.
Have you seen the pushback from some of the Democrats because they feel blindsided by President Biden potentially joining with the GOP?
Yeah, but what are they pushing back against?
Just that there wasn't necessarily visibility. It's an interesting kind of fissure. That's what we were talking about.
I agree. The future's just about unchanged. Vichy Tirupatur of Morgan Stanley, up next. 3 days of gains on the S&P 500. Can we make it for the fate of today's price action? Maybe in the hands of Chairman Powell in front of the Senate Banking Committee a little bit later. That's called a tease, Tom. Bit of a promo for Chairman Powell later. Whenever we do this, though, whenever we set the stage for the Fed chairman down on Capitol Hill in front of the Senate Banking Committee, it's sometimes a bit of a dud, isn't it?
Sometimes.
Who writes the senators and the representatives' questions? They don't come up with them.
I'm sure
themselves,
they've got
do
a
they?
decent team behind them. Some of the questions, you kind of sit back and you're like, oh, that was actually quite smart. I wonder who wrote that.
Well, yeah, the ones that actually get into the weeds a little bit, they're probably not analyzing monetary policy.
You've got a friend on Wall Street. I know where that's coming from.
100%.
Equity futures up 0.2 on the Nasdaq too. Let's just whip through the bond market as well. 2s, 10s and 30s shaping up as follows. Your 2-year just backing away again from where we were last week. Through 490, we're at 487 at the moment. Through 4% last week on a 10-year, 390, 382 right now. Yields down a couple of basis points as well. I promised you some ECB speak.
Oh, please.
So we had one ECB official from the Austrian Central Bank, the governor there, Holzmann, is talking up 450 basis point hikes. So another 200 basis points of tightening at the ECB. Now, yes, he is the biggest hawk on the ECB, but the fact there is someone willing to go into the Governing Council meeting maybe later on this month, Tom, and make that argument just tells you where some of the committee's at and what the debate might sound like.
I totally agree, and I'd also agree that the screen right now, the Bloomberg terminal, is very deceptive because, John, you mentioned here yields are churning a little bit, and yes, they're a little bit lower, and maybe the curve is doing this thing, but the fact is the vanilla 2s10 spread is breaking out to new greater inversion. We're not quite there within a little bit of a stinch going back 2 days. And the broader 3-month 30-year piece is now back under a full 1 percentage point difference between 3-month paper and 30-year paper. So there's some tension in the data check today that's maybe not that evident.
It might be quieter today, but that tension was evident yesterday. We had a 10 basis point move at the front end in Germany off the back of those ECB comments. And Lisa, I have to say, for me at least, what I'm paying attention to, they talk about dropping forward guidance, but then they offer pretty firm guidance for the next meeting. They're saying we're probably going to go 50 at this one. It's whether they do the same again coming out of the March meeting. And based on what we're hearing so far, there might be a good chance of that.
And what they say about the balance sheet as well, whether they start to actually unwind and sell off some of what they've accumulated on their balance sheet. Let's take a look at some of the stocks that are moving ahead of the open. Dick's Sporting Goods shares are popping after reporting earnings that were better than expected, seeing the adjusted earnings per share for the upcoming year of $12.90 to $13.80 versus an estimate of just $12 basically and 3 cents. Basically, same store sales up about 5%. Wonderful results across the board. Those shares up 4.3%. Just the tale of the haves and the have-nots within the retailing sector. I'm not surprised that people who buy cleats and bats and things like that for their children might actually end up fueling the sales here, just theoretically. And we're also looking at Meta. Those shares up 1 point.
Have we got a child playing baseball? Is that it just sounds like someone was deeply disappointed with how much things cost over the weekend.
Whether it's the baseball bat,
how much is the bat now?
The bat can cost anywhere from, if you get a good one, it can cost over $100.
No.
And then, the cleats, and then, with batting gloves.
Do they
and then
last,
things.
though?
Well, it depends if,
Lisa,
you believe in the pop hole theory and all that
I've got two
stuff
words
and
for you.
all that stuff, yeah.
Ice hockey.
Yeah. Oh, that's, I'm sure, such a
Real
cheap.
money.
Yeah. Maybe just carding.
My football
I heard.
boots used to last me a season. I'd get through a season with one pair,
What about shin guards, your socks?
I'd hold on to them, but I played for a team, so we got given all the
there you go.
jerseys.
Does your offspring have the bag with the bat with like the 8 bats in it?
I don't want to talk about it.
Which...
Let's move on to Meta. Meta is doing more layoffs, which is really interesting in light of November. 13% of the workforce, that was the announced cut back then. And at the time, Mark Zuckerberg said this was the last of it. Now we're hearing that there are thousands more being cut. Those shares up 1.3%. And Rivian, this is fascinating. We talk about Tesla and their dominance over the EV market. Rivian shares are down more than 7% because they're offering $1.3 billion of green convertible bonds, basically that could potentially dilute the shares. But the bigger point to me is that they're raising more capital, the plug, the fact that they're burning through cash as they try to compete with some of the other behemoths.
We can't do this right now. I think it's brilliant, Lisa, and we can't do it right now. We got to get to Vichy, but I'm sorry. I think this whole EV thing needs a lot more chat. I just I'm a complete amateur on it, but I think you're dead on to feature Rivian there. He is a chief fixed income strategist at Morgan Stanley. Vishy Tirupati joins us right now, synthesizing in all of that historic fixed income platform. Vishy, I love what you say because we're feeling it every day here at Bloomberg Surveillance. It is a data haze. There's no question about it. Where out there is the clarity you write of?
There is really a data haze. Is conflicting signals. On the one hand, we've had the inverted yield curve that you referred to just now. That's giving it a different signal. The PMI new orders gave a different signal, and the signal of weakness. The leading economic indicators on the conference board similarly. But on the other hand, we had a gangbusters payroll number. We had very strong retail sales. So we've had very conflicting data. So this is I think that this week and the next week are going to be important weeks for getting some sense of where is this data, what is the data, what are the data telling us?
On a blended basis, can you use the new ample coupon to protect yourself if we get further price down, yield up?
In fact, that is the case. What we are recommending to our clients is neutral on duration. So it doesn't feel like a move of, say, 25 to 50 basis points on either side of the can happen this week and next week. So we are basically saying until we have greater clarity on the trajectory of economic growth, are we heading for towards a soft landing, which is what our base case of our economists is, or this construct of no landing, which we're not big fans of. I think we need to have some. We have to, until we get some clarity, we will be neutral on duration, neutral on dollar, and stay very high quality and much lower duration at the front end.
Vishy, that's interesting. Given everything we've priced over the last month or so, now a terminal rate priced at something like 540, you still think the risks around the bond market are that balanced?
I think at this in this week and then perhaps or next week, I think there is risks are really that balanced. I think that there is if we the data from January, the payroll data especially, was affected by a number of things. It was affected most importantly by seasonality factor adjustments and by the weather. The seasonality factor adjustments will not help the February numbers as much. On the other hand, we also had a relatively warm February. So putting those two things, it's pretty conflicting. So we would really our base case expectation is a below consensus expectations for our economics team, below consensus expectation for non-farm payrolls. But given the wide range of outcomes that we have seen over the last several, at least in the recent past, whether we end up in a downward trending, labor market, employment, non-farm payrolls towards a downtrend, or was January not a blip? That's, the outcome of either of those outcomes can be mean very differently for the bond market.
Let's talk about what the potential market responses would be to either of those outcomes. If we get a hotter than expected print on Friday, what does that do in terms of your expectation of how high rates could go? And then on the flip side, how much could the market retrace some of the hawkishness they've priced in?
I think in either way, in either case, at least 25, depending on the extent of the surprise, it could be even bigger than that. That kind of a move is what we would expect to see. If we have a 350 type of number for non-farm payrolls, that could significantly bring the probability of a 50 basis point hike, higher up in the, it will increase the odds of a 50 basis point hike in March. Not our base case. But I think it's I think we'll hear Chairman Powell reiterate that the data dependency of decision making, and as he speaks today, he would not have the full knowledge of the employment, the Friday's employment report coming in. So he would be in the same level of uncertainty about data as we are all.
Vishy, before we let you go, I'd love your thoughts on what happens with Bank of Japan on Friday. How much does that matter for the U.S. bond market? We were talking about this with Alan Ruskin of Deutsche Bank, and he said it might not have that big of an impact on longer-term U.S. yields. Do you agree?
In terms of, I think that my personal expectation is on the 9th, we will not see a change in yield curve control. It will be. I think our expectation is over the course of the year we will see changes to yield curve control, not on March 9th. And whenever yield curve control goes away or we move towards a higher part of the JGB rates, the effect is not directly so much on the U.S. rates itself, but I think it will be the incremental demand for the spread product. I think the incremental demand for spread product, be it credit, be it securitized products or MBS, those spread products hedged into yen terms would not look nearly as attractive as they do today, or that they did some time ago. So it's not the direct effect on the rates themselves, but really I am or would be concerned about what it means for incremental demand for all these other products, not so much directly the treasuries themselves.
Vishy, always great to catch up with you, sir, to get your view on this fixed income market. Vishy Tripatur there of Morgan Stanley, the chief fixed income strategist over at MS. A little bit later today, 10 a.m. Eastern time, you will hear from Chairman Powell in front of the Senate Banking Committee. If you are just tuning in, you'll hear from him again tomorrow in front of the House Financial Services Committee. Sometimes, Tom, the tone and the questions are different in that one on the Wednesday compared to the Tuesday.
They are, and they're both of value. I think it's really important
That's kind of you.
Humphrey Hawkins was invented to give more communication in a time of dramatically less communication. I don't think it's nearly as important as it was 20 years ago because these people just speak nonstop. I mean, do we have Feds? We don't have Fed speakers today. Are they in quiet period now?
No, not quiet period until Saturday.
Till Saturday.
So end of the week.
How the hell do you know that? You're just a font of wisdom.
Because the meeting's on the 22nd. So it's usually the whole week before is clear, and then.
What about Sundays? They can talk on Sundays.
They can talk on Sundays.
Yeah.
Just, God.
News you need to know.
They can't talk. You won't hear from them again after Friday.
Do you know I'm on an airplane for the Saudi Arabian Formula One?
What's that?
I may have to cancel my trip.
Oh, right. Who are you flying with?
I'm flying with United.
To Jeddah.
No, Francine is a Gulfstream, so I'm flying United.
In 2 weeks.
2 weeks.
What kind of wheels do they use? No, I'm kidding.
United plane. You.
Let's move on.
They're Pirelli, but I don't know if they're. It makes
tires
a difference,
are very expensive.
Right?
Oh yeah.
They want to be on soft wheels, right?
Tire deck. Well, it depends what kind of track it is, and what your strategy is.
And then in rain, they have grooves like we have.
Yes. Yeah, wets.
See, I'm learning.
You can have wets. You can have intermediates, and then you can have full wets. Yeah.
Wets. Okay, yeah. I'm learning.
That's good. Welcome to the show.
The Rambler has changed. That's all I know.
Futures up for 10th. This is Bloomberg.
Always learning something new. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, the job cuts aren't over at Facebook parent Meta Platforms. Bloomberg's learned the company is planning a new round of layoffs and will cut thousands of employees as soon as this week. In November, Meta eliminated 11,000 jobs. That's 13% of its workforce. Taiwan's President Tsai Ing-wen reportedly persuaded House Speaker Kevin McCarthy to meet in the U.S. due to security concerns. According to the Financial Times, Tsai's government shared intelligence with McCarthy about threats posed by China. McCarthy has said he wanted to visit Taiwan at some point. The powerful sister of North Korean leader Kim Jong-un has issued a new warning to the U.S. and South Korea. Kim Yo-jong is threatening severe consequences if the two countries go ahead with joint military drills next week. Last month, North Korea threatened to turn the Pacific Ocean into a firing range if the exercises took place. Consumer expectations for Eurozone inflation have receded significantly. That's according to the European Central Bank's monthly survey. Expectations for 3 years ahead plunged to 2.5% in January from 3% in December. The pullback comes just over a week before ECB policymakers are due to set interest rates. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
what the story is of 2022 as well, where we started to see unusual market conditions, currency changes. We also started to see inflation. That is when all of a sudden 2022 was not like 2021, and the surge of employment and all the things we did to invest for 2020-22 that never really showed up. We have made changes to our company to reflect current market conditions.
Just very cool to hear from Mark Benioff, the Salesforce chairman and CEO, in the last week. Trying to look forward to a better year, that's for sure, over at Salesforce. This is what Meta's looking forward to potentially. We're reporting they're planning a fresh round of layoffs as early as this week, according to people familiar with the matter. This coming on top of a 13% workforce reduction in November. The CEO, Mark Zuckerberg, saying at the time, I view layoffs as a last resort, so we decided to rein in other sources of cost before letting teammates go. Overall, this will add up to a meaningful cultural shift in how we operate. We'll roll out more cost-cutting measures like this in the coming months. And Tom, the coming months might mean this week we do it again, just a little bit more.
I think the reality here is to look at the history of it with all of these companies, including the miracle that I believe Apple didn't overhire. John, I'm stunned by this. Meta, number of employees pre-pandemic, 45,000, and now 86,000. I did not know that.
Oh, did the same with Amazon. It was something like 800,000 into the pandemic and more than 1.5 million coming out the other side.
I think Amazon, we get like it's the last mile, it's warehouses, it's trucks on, whatever street. But with Meta, I mean, what are they doing at Meta? They're all in offices or work from home, doing what Meta does, Instagram and, Facebook. And I had no idea they went from 45,000 to 86,000.
Demand just went through the roof across the board at these firms.
Let's get a brief on that right now. And you know who we turn to, Mandeep Singh, Senior Technology Analyst at Bloomberg Intelligence. An amateur like me, Mandeep, looks at 45,000 out to 86,000 and go, duh, they overhired. Did they overhire?
Well, they probably did in hindsight. And I think what they saw was revenue accelerated. They doubled their revenue in this time period. So typically the way tech companies go about it is if revenue growth is, let's say 25, 30%, they will expand their employee growth in line with revenue growth. And that's what Meta and a lot of other tech companies end up doing. The timing of this cut, given it's coming, just after a few months of the last cut, suggests that they are probably not seeing the end of this downturn, especially in terms of top line acceleration. Right. And I think that's where you could question how much is the metaverse pivot responsible for it, because metaverse right now, the Reality Lab segment, it's like 2% of their revenue, but it's 20% of their employee base. So that's something to keep in mind.
What I think is so important here is a broad look at technology. Is the digital ad growth party over? I mean, there was just an assumption there would be digital ad growth forever, forever, forever. Is that really what we're talking about here? Is it's finally done?
No, I think it still is cyclical. And the reason I say that is right now, when you look at the advertisers, it's mostly e-commerce, gaming. These type of advertisers have pulled back a lot because they're seeing slowdown in their core businesses. You compare that to travel advertisers or financial services, they're still aggressively spending on ads. And look, when it comes to digital ads, they are definitely more targeted than your linear TV ads. So I do think, given we are talking about ChatGPT and large language models, it's going to make those ads more targeted over time. So that secular trend will remain. The question is, who has the engagement? Because at the end of the day, you're going to show ads at places where people are engaging. And those platforms, whether it's Meta or something else, that's what needs to be figured out here.
Or TikTok. And I wonder if that engagement at TikTok gets sort of segmented off by the U.S. government. Who benefits the most? Is it Meta?
I think it's going to be all of the digital platforms. Meta, probably more on the Instagram side, but YouTube, we think that is one of the biggest beneficiaries simply because YouTube has the scale, 2 billion monthly active users. And now a lot of the streaming, when it comes to, your core cable TV channels are being viewed on YouTube. And that is quite powerful because when you layer targeted advertising on that platform, which is basically showing different ads for different types of demographics, that's quite powerful. And I think a lot of that secular shift in ad spending to digital platforms will happen on streaming.
Before I let you go, Mandeep, we started talking about the layoffs at Meta and how Facebook is doing another round of cuts potentially this week on top of what they did back in November. How far are we from seeing the end of tech job cuts?
Well, this in particular suggests the fact that Meta, which is 85% of social media time spent, doing another round of layoffs suggests we are probably not seeing the light at the end of tunnel here. And it's probably got some more room in terms of this downturn. And the top line acceleration is probably a 2024 thing at this point of time.
Given how difficult it was to hire Mandeep, are some tech firms taking a different approach and just saying, OK, we made a mistake, let's try and grow into it over the next few years?
So you could say that for software companies that have a recurring subscription model. I think it's harder for ad companies, which are more transactional, and their ad pricing is determined through an auction. So clearly, it'll be harder for them to have a control on their top line. But for companies that have a recurring model, this is the time where they think they can get more talent as well as make sure that morale stays high, and they're going to come out stronger if they show cost discipline.
I was also
at this time.
thinking about Amazon as well, Mandeep, a company you and I have talked about before. Tom and I mentioned it. They basically doubled the workforce through the pandemic, and they've come out with very minimal, marginal cuts to the headcount. Why do you think that is?
Well, because one thing is when you look at the last mile delivery or all the things they're trying to build around the e-commerce side, these are secular trends. It's not as if, the world is going back to the pre-pandemic ways, and a lot of the change in behavior is going to stick. The question is, when will there be a rebound in terms of growth? And that's why I think if they have the scale and they continue to operate with, cost cutting, they will be at a point where the scale player eventually wins on the internet side. And I think that's where Amazon definitely has an advantage.
Hey, Mandeep, wonderful to get your thoughts, as always. Mandeep Singh there of Bloomberg Intelligence. Meta almost flat over the last 12 months now, because year to date, it's up 54%. Yeah. It's absolutely,
I nailed that.
Absolutely flying, Tom.
We did not have that in the triple leverage all cash GDP.
You get 5% on T-bills now, Tom. You should be happy with that, shouldn't
you? I don't know what to make of this, and I respect immensely where Mandeep says it's not about a digital ad slowdown, but I'm just, coming out of the pandemic, what's the new digital look like? What's the new, and I don't mean just Meta, I mean the whole complex of huge revenue growth dominant West Coast companies.
I mentioned 5% on T-bills. Lisa, finally, hello, CDs. They're starting to offer some interest now over at the banks.
I think more than a dozen banks are starting to offer about 5% on CDs, but it isn't the major ones. And this is what I find interesting.
So dragged, kicking and screaming.
Basically, the major banks are saying we have plenty of deposits. We don't need to attract them. So if you're, Capital One, go ahead. You can offer a 5% CD, but you're not going to compete with us. And then maybe around the edges, they have to start pushing up their rates too. And that's what you're seeing. It's incredible competition.
The toasters are coming back, Tom. You hear about that? Toasters are making a comeback. You've been waiting for this for 10 years. Free toasters. That's all he's waited for.
Yeah, he hasn't even bought a toaster.
Just wants the competition.
Yeah.
Marcus.
So the toasters return.
Here we are. Good morning, Mr. Solomon. Marcus, 3.75% APY. It's 4 times the national average. No fees, no minimum in that. But it's that game. They're slow to raise rates, aren't they? They just
A lot of these banks have so many deposits. I mean, the Bank of America, JP Morgan, and they were actually talking about how they didn't want so many deposits because it became a liability for them. So, until we see them actually start to lose deposits at a fast enough pace, they may not raise rates as much as other banks, at least on their CDs, et cetera. But here's the issue that I'm wondering about. When do people start to realize they are losing a ton of money that they could otherwise get in just flat cash in the bank account? I mean, there is this inertial force. I mean, it's just the extra paperwork and having to deal with it. Isn't it going to right size anyway? I mean, there are people who think like that.
Yeah, are you describing yourself?
Just theoretically.
Talk about this every day. You're explaining to our audience you're sitting at 0% right now, Lisa. Is that where you're going with this?
Move on.
I'll move on for you. Okay.
I talked to our people yesterday outside the prospectus as we write for the ETF, and John, the simple answer is if we get 6% 3-month LIBOR, we get a 2 and 20 payout on the triple leveraged all cash
nice.
Fund. We actually get finally back to.
We get bonuses.
You guys are on the board of directors.
No, Vet Bill was on my seat.
You're on the board of directors. It's good. So is Vet Bill.
I hope Mike Wilson's not listening to this because I want him to stick around from Morgan Stanley, the chief equity strategist, is going to join us in just a moment. We'll catch up with him as he acknowledges maybe you can get a pickup.
This is important
in
for,
this market.
For global Wall Street. This is important.
He said equity survived a crucial test of support. That suggests this bear market rally is not ready to end just yet. Mike Wilson up next.
I think inflation is complicated when it comes to the U.S. equity market outlook.
It's hard to feel confident you're going to get inflation all the way back down to the 2% target that you see.
We're still in this kind of slower climb up.
The Fed can get inflation to wherever they want it to be. They can get growth to wherever they want it to be. The question is what needs to happen to rates.
Right now, the market's putting about a 30% chance that the Fed will go 50 basis points at the March meeting. It wouldn't take much to push that over 50%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. A must half hour here for Global Wall Street. Michael Wilson of Morgan Stanley will join us in a moment. And within the data haze that we heard earlier from his colleague Vishwatara Patur, John, it is a data haze going to the chairman's discussion this morning.
One question for Chairman Powell. Will he validate market pricing? We're now looking at a terminal rate, Tom, of 540. Will he give that the official seal of approval going into payrolls on Friday and CPI next week? It's going to be difficult for him, TK, because the narrative switched so quickly after that payrolls report for the month of January that we got in early February after their last meeting. He sat there in that news conference and said the disinflationary process has started. Will he repeat that phrase a little bit later in front of the Senate Banking Committee?
You go to the physics of it, which is he going to be so brave as to say that? I don't understand how he can do that. Not only the headline data coming out, but all the minor data as well really adds into it.
Well, I think Vishy really phrased it well. The two-way risk around the data this week and next week, Tom. Yeah. Payrolls Friday, CPI on the 14th. There's a lot of two-way risk. You either get confirmation of that buoyancy, that strength in the January data, or you don't. Right. And we flip aggressively the other way, Tom, pretty quickly.
1991, the Dow Jones Industrial Average, 2,900. Now it's at 33,000. I know, John, that you need to know that to get a benchmark here. Lisa, the great Jules Westheimer of Wall Street Week. Mike Wilson was a little kid at home with his popcorn in his hand on Friday evening watching Louis Rukeyser and Jules Westheimer. And Mr. Westheimer said, gloom rules on Wall Street. I mean, that's really where we are until we don't, like Anna Hahn or like Mike Wilson.
I disagree. I think that gloom isn't ruling at all. I think that right now there's an optimism that's been ruling at least since the beginning of the year. And now there's this feeling that perhaps the U.S. can get past 5.5% rates, 5.4% rates for a year without seeing some sort of major recession. I mean, how many people are just full on, just deeply unapologetically bearish right now?
For all of you on radio and television, stop what you're doing. An extended conversation here with Michael Wilson. We got to do the data first, John. Sure. I'm looking at curve inversion that won't go away, negative 93 basis points on 2's 10 spread.
But yields have backed away from the levels of last week. The 10-year was through 4% for the first time since November. We're now down another 2 basis points to 393.82. In the FX market, euro dollar negative 0.1% at 106.68. And in the equity market on the S&P 500, about 4K, and we're positive 1/10 or 0.2% on equity futures. There was just one quote yesterday that stood out for many of you at home, I know. It was from Mike Wilson of Morgan Stanley, and it read as follows. Equity market survived a crucial test of support last week. That suggests this bear market rally, Tom, is not ready to end just yet. How much of a change was that from Mike and the team?
This is a pretty substantial change. We're going to dive into that right now with Mike Wilson. Mike, John wants to dive into this. I'm going to talk right now. I got to make some news here, Mike Wilson. So help me out. The great Ralph Ancampora was on a while back, and he said, "Look, there was an October bottom." We've heard this from a few other select people. With this more optimistic call by you, can you call an October bottom? Can we call it the Ancampora-Wilson bottom?
Well, good morning, guys. Thanks for having me as usual. Well, we did call that bottom in October, and we thought it would, be a substantial rally, 15, 20%. We got that rally, and then we decided, well, the risk reward is no longer attractive, and so we backed off of that, and we said we'd probably go down and retest those lows at a minimum and probably take it out, which is really based on our fundamental view that, the earnings recession is now in place. people acknowledge that, but I think there's a very wide range of how deep that earnings recession is going to be, with us kind of on the deeper end of that range. Now, this past weekend, we looked at the chart. But we have to be objective about what we see. We're technicians in addition to fundamental strategists, and we looked at the price action last week, and we actually talked about it in the note the week before. We said, look, we're going to probably test this level. If it holds, it'll be a constructive marker, at least in the short term. And that's how we're viewing it now, Tom. It's a short-term positive. I don't think it changes our intermediate-term view that, the risk reward is still pretty lousy at 4,100 because of that earnings recession view that we have on the fundamental side. So we remain in a trader's market, and part of our job is to help people navigate that.
So, Mike, just to be clear, how different is this call compared to the call for the tactical rally you made back in October?
Oh, it's very different, John, because, in October we were trading 3,500. The valuations were 15, 20% lower. Interest rates, were higher. We felt like they were going to come down. So we had a lot of catalysts. China, reopening. There were a lot of reasons to believe that was a very tradable low, not just for trader types, but for people who run real capital. And it turned out to be the case. So, we don't always get that stuff right. It's impossible to get it right every time. So this is much more tactical. This is just sort of saying, look, we acknowledge that the technical picture held. We didn't know that was going to be the case, and so you have to respect that. And hey, they could turn down this afternoon again, for all I know, given what Jay Powell's going to say in his testimony. I have no idea. Maybe that triggers people to get negative. One thing I will say to you all, however, is that we're pretty confident that between now and the next earnings season, which isn't that far away, that will be when we think the next, bear market kind of decline happens. Maybe like a more meaningful decline, 10% plus.
So, Mike, we can get further down the road in just a moment. I just want to sit on the early part of this year. It's difficult to get everything right. You put out a note early in the year and you said 3,900 was an easy sell. What's more difficult about it now besides the technical point that you've made?
Well, I think there's a couple things you have to acknowledge. I mean, the economic data has been better. China's reopening is kind of just getting going, and they've kind of held back. They could gather some steam. So those are things you have to say. Look, I mean, I think people came into this year feeling as if the recession was inevitable, and that no longer is the case. It's probably 30% chance, maybe 40% chance at best, and that can keep animal spirits alive. The other thing that's happened, John, is we've talked about multiple times, is this liquidity picture from outside the U.S. So the Fed's doing their job, trying to tighten financial conditions. The problem for them is that we have the Bank of Japan and we have the PBOC adding liquidity, and you have a dollar that's kind of softening up, which is kind of neutralizing, the Fed's goals of tightening financial conditions. And that's also kind of breathed some life into risk assets. So that's the only thing that's changed. Ultimately, we think, valuations and the fundamentals, meaning earnings, will determine where stock prices trade. That setup is not particularly great, particularly to move higher in rates this year.
Given some of the changes that you talked about just now, Mike, how much does that change what floor you could see in your bear scenario for equities?
Well, I mean, look, we have to be flexible. We're trying to, also service a lot of different types of clients, right? Whether we're talking about trader types or we're talking about asset owners. For the asset owner crowd, we've been pretty adamant. We felt like the fall was a really good entry point where people had a longer time horizon. And if you added risk there, you probably just stay with it. I do think people, though, are getting a bit carried away on what they've been buying. Okay, so I think they're, given the rally that we saw in the fall versus the rally we've seen this year, they have very different sort of complexions, right? The rally in the fall was based on, we think, fundamentals, meaning rates coming down, economic data getting better because of China, globally at least, and that would help the kind of cyclical type areas of the market. Then we had this more speculative rally that started in January, kind of buying last year's losers, which was all the growth stocks and the meme stocks, whatever you want to call them. And those have just gotten out of control again, particularly in the context of higher rates. So I think there's a lot going on, right? And I think there's two ways to think about it. If you have kind of, names that you want to own, through, you want to underwrite through what we think is going to be a difficult time for earnings, and you say, look, I think there's value in this security for the next 3 years, great. You should just own those through that period. However, there's a lot of stuff that's gotten dragged along here that is wildly speculative now, in my view. It's actually somewhat reckless. And that's the stuff that you got to be really careful what's in your portfolio. Got to get it out of there because that stuff has gotten revalued in a way that doesn't make much sense to us.
What kind of downside could you be talking about? And I assume you're talking big tech names as well as some of the other meme stocks.
Well, for some of this stuff, I mean, I think there's plenty of stocks that are probably going to go bankrupt. I don't think that's a crazy statement, but that's not the bulk of the stock market. Okay, so this is a pocket of the stock market, and then I would say, but overall, like the growthier stuff and the thing that even the cyclical names that have gone too far now could have as much as 20% downside, no problem. I mean, like that. Our valuation work would suggest that even without the earnings recession, right, the valuations are kind of out of bounds again. So it's a stock picker's market. A lot of people are saying that. That's usually what people say, by the way, when they're having a hard time calling the direction of the market. We do it too. So everybody says, oh, it's a stock picking market. Well, that's hard. Okay, so that's not an easy game to play, but it is a stock picking market, and the stocks that are likely to go up versus down is probably less than 50%. It's a stock picking market with not a great macro backdrop. So that's the challenge.
Mike, I always appreciate how you
come
acknowledge
back and talk about that.
How you acknowledge some of this and how difficult it is right now. Mike Wilson and Morgan Stanley is going to stick with us, and we will come back and talk about that conversation in just a moment, Tom.
I think it's just critical here. To me, this is, Mike and I have been through this a million times. All of a sudden, with gravity returning, all of a sudden with interest rates we haven't seen in 16 years, it's not that the party's over. It's just we've returned to normal dynamics. And the key dynamic, and this is off my great mentor in England, Lord Desai, at London School of Economics. You know what matters? Profit, free cash flow. And there's a lot of people out there right now without profit, without free cash flow.
And this call from Mike is a big earnings call. Let's be clear about that, Lee. So this is about earnings. He does not think earnings are going to impress this year.
And we've already seen unimpressive earnings. Let's be really clear. We didn't see gangbuster results. We saw things that really disappointed more than usual in terms of the latest earnings season. So how bad did things have to be to kind of get us maybe in a different mindset on a market level, but we'll be picking stocks?
We'll continue this chat with Mike Wilson and Morgan Stanley, the chief equity strategist, in just a moment. Just to give you the lineup of things, a little bit later this morning, 10 a.m. Eastern Time, you hear from Chairman Powell, confronting, facing off, grilled by. All those headlines are always the same, aren't they? By the Senate Banking Committee. And then it starts.
Several senators.
And then it starts, and it's just like, okay, how many hours of this? Yeah, okay. Yep. Looking forward to that. That starts at 10, and then, if that's not enough for you, he does it again in front of the House Financial Services Committee on Wednesday.
It usually ends 2.5 hours later. It usually lasts that long.
So what do you make of the quality of the questions in the House on a Wednesday?
I think it's a different quality. I think it's stock picker kind of quality.
Very diplomatic.
I'm trying.
Your bond market yields in 2 basis points, 393, futures up 0.2. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden will propose raising taxes on wealthy Americans to help avert Medicare funding crisis. His plan would boost Medicare taxes from 3.8% to 5% on certain kinds of income above $400,000. It would also allow the government new power to negotiate drug prices for Medicare. Bloomberg has learned that more job cuts are on the way at Meta Platforms. The parent of Facebook will cut thousands of employees as soon as this week. And that follows a 13% reduction in November. Meta has seen a slowdown in advertising revenue and has shifted focus to a virtual reality platform called the Metaverse. China is shaking up oversight of its technology sector in the wake of a tech battle with the U.S. A national bureau will now manage and police data resources while building up China's digital planning. Meanwhile, the Ministry of Science and Technology will be strengthened to formulate strategic policies and orchestrate nationwide initiatives. In France, unions are hoping to bring the country to a standstill in a 6th day of protests. They're demonstrating against President Emmanuel Macron's plan to raise the minimum retirement age. Transportation is likely to be severely disrupted. Only 1 out of every 5 high-speed trains will be running. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We can still have a soft landing. A mild recession is possible. A harder recession is possible. I think there's a good chance that inflation will come down, but not enough by the fourth quarter. The Fed may have to do more. And I think a lot of things that have happened in the world, think of the bigger trends, are inflationary.
Tom's favorite thing when CEOs of financial institutions start talking
Oh,
macro.
John knows after
Love
the third beverage I get going on.
I saw a
this.
load of headlines from comments from Brian Moynihan of Bank of America overnight. All these comments were coming through, and I was like, yeah, that's what Mike Gapin says of BFA.
100%.
Just read his research.
Yeah.
Not really news, but anyway.
I'm going to cut James Dimon some.
Oh yeah, I wasn't talking about Dimon. I'm talking about BFA.
Brilliant. He synthesizes in, John. I'm guessing 200 people help him write his annual letter. I'm just guessing out loud, and I wish other bankers did short or long, like Mr. Buffett from years ago or Mr. Dimon now. I find them valuable, and they touch on different tones and themes, and I wish it was more like that than, what do you think about Y equals C plus I plus G plus NX?
It really highlights the stock picker versus the macro, right? Everyone's a stock picker when macro gets too difficult, unless you're a CEO, and then you go macro because you don't have to say anything because nobody knows anything. But if you're a stock picker, if you're arranging your business, how do you end up making decisions if the macro is so uncertain?
Well, I think we're going to continue this conversation with Mike Wilson and Morgan Stanley in a moment. And what Mike's been great at, Tom, over the last few months is explaining that you could see a difference between the real economy and what develops in stocks. The earnings are different to what you might see overall in broader GDP.
Absolutely. I'm a huge believer that the linkages are suspect, to say the least, and the financial media likes to move it in lockstep. Let's get back to this conversation with Mike Wilson, hugely influential across all of global Wall Street. He's the chief U.S. equity strategist and CIO at Morgan Stanley. Mike, I want to go to what I think is the great divide. As Taleb says, the gravity has returned to the system. You remember this when you were studying this at Ann Arbor years ago. The bottom line is, when you get a normal interest rate structure, all of a sudden down the income statement matters. Divide for us now how you look at those that profit from those that do not profit. That seems to be a new metric.
Yeah, I mean, I don't think this is a new metric. I think it's a forgotten metric, which is that, your costs sit on your balance sheet until they have to hit the income statement. And, this whole idea of accrual versus cash accounting, which we did learn, seems like 40 years, probably was 40 years ago. And I have a history of studying accounting, and it's a great tool to kind of see through the noise. And this is why we, our note this past week, we highlighted a great report done by our global tax evaluation team, and basically highlighting this, spread between cash flow and net income that's being reported. That's all based on accruals. And so it ties into everything we've been talking about for the last year and a half, which is the pandemic, the lockdowns, basically brought on this incredible period of over-earning by corporations because their costs were slower to increase than their revenues came back. But now we have the exact opposite, which is that companies, basically accrued these costs on the balance sheet at a bad time when, inflation was running hot and they thought business was going to continue to be that strong. So they built for it does not actually happen now. And that has to flow through the income statement, and that will hurt margins. And that's the story. The question is, will the markets look through that and suggest, well, we know this is temporary. Ultimately, companies get their head around that, which we agree with. But our experience is that markets will not look through it if the earnings degradation is as severe as we think it's going to be.
Mike, I mentioned there that you see a difference between what could develop in the real economy and what could happen with earnings. How well received is that with clients at the moment, Mike?
Well, look, investors understand that concept. I didn't invent that. So, I think they very much appreciate that concept. The problem is that it's noisy. And there is this, we live in this world now where there's sort of almost like hand-to-mouth guidance, the Fed, doing it for the bond market and companies doing it for the stock market. And so it's a process that takes longer than it probably should. And that's what's frustrating, I think, for some investors who are in the weeds on this, where we are. It's like, well, my goodness, it's pretty obvious what's about to happen. Why is the market taking so long to kind of price this? And that's just the way it is. And that's not a new phenomenon. That's kind of the way it always is at this stage. When you get a significant earnings recession, it just takes longer than you would think to get it priced.
Do you get more questions about single names now, Mike? And what single stock ideas do you offer them?
We do, but I think most of our clients are pretty good at that job. They do a good job. That's their job essentially. We absolutely help them. We do run a model portfolio. As you know, we've had great success with that. But it's a helpful tool. And then we run a lot of screens for people based on our view of the world from a macro standpoint, saying, okay, these factor variables should be in effect, and this is what you want to, kind of put in your portfolio. We run those screens, and that's kind of how we go at it. We don't, talk specifics necessarily with clients around, individual companies as much as, say our analyst team does. Which is really their job.
But let's talk about sectors, in particular with margin compression. If the service sector, is possibly seeing more, perhaps, wage pressure, need to pay more to people to bring them in the door than, say, tech stocks, how do you look at where margin compression is going to be the greatest and what could potentially get hit as people trickle through and realize this new kind of reality?
Well, that's exactly right. Now, one of the other features we just touch on for a second is that the recovery itself was sort of two-staged, right? It was goods first, then services. Normally, in a normal recovery, everything comes back at the same time. So you have this sort of rolling recovery and now rolling recession. Tech is in a recession right now. I think that's obvious, right? They're losing, they're seeing negative growth. They're laying people off more aggressively in other sectors. And I think the big question for the economy is, does that spill over into the services sector, which is where employment really lives, right? I mean, that's small, medium businesses and services companies employ a lot more people, as you suggested. Look, we think ultimately this will roll through kind of the entire economy. Services will probably get hit later in the year when other businesses are showing weakness, and then we're seeing layoffs there, which then people spend less money. So it's sort of a circular argument, but clearly this idea of operational efficiency is what the market's paying for. So companies that are showing good inventory controls, labor costs as a percentage of cost of goods sold are smaller, and then capex depreciation is lower. And this word efficiency has been popping up. I find it very interesting. We're hearing it from a lot of different companies. We've been talking about that for 12 months. So people are catching on, and but we think that it's not over. We think the market will continue to pay for companies that are very efficient with their expenses and can get the revenue to the bottom line.
This is fascinating, Mike. Are you saying that in the months to come, the goods sectors that perhaps have already seen the downturn will outperform as margin pressures and some of the downturns start to hit the later recovering sectors, namely services, leisure, hospitality?
We think that could be the case. I wouldn't say that's like a high conviction view, but we do think that a lot of the goods sector stocks in particular, and even the earnings forecasts, have come down because it's obvious, right? We had a pull forward of demand, and so those numbers have been reset. The question is, what does the demand profile look like for some of those businesses that were basically COVID winners? Are they winners in the long term? That's to be determined. And then services, we do think has gotten a bit frothy, and it's gotten, there'll be demand destruction as prices are a bit out of control there. So it's just messy, and that's why I think this, our view, we do a lot of work on top-down earnings, which we have high conviction in. That way, we don't have to focus so much on trying to call the economy, which I think is a much trickier, thing to do. Calling a recession is very hard because you never know when that light switch is going to go off on employment. But when it does, it's, it's immediate, and it's just, there's no lead time. It's just all of a sudden it hits you. With the earnings picture, we can see out 12 months pretty good, and that's why we've had conviction there.
Mike, well said. As always, fantastic to catch up with you, sir. Mike Wilson there of Morgan Stanley. Thank you very much for being with us. Difficult moment in this equity market, Tom. Tough to call.
Tough to call because, as he said, we have not. I liked how he corrected me. He said, this is not a new regime. We've returned to an old regime. And there's just so many people on radio and television right now who've never lived this new world. And there we are, as you mentioned, with CDs.
It's funny, Tom.
Forward 5%.
And Ruskin of Deutsche Bank said the same thing about a different asset class, didn't he?
Yeah.
Yeah.
I mean, it's a whole new world after all. That's all there is to it.
You're going to sing that one?
No, I'm not going to sing.
Okay, all right. Just checking. Get grumpy
It's
about
from Aladdin.
There you go. He's going to sing anyway.
I know, exactly.
Grumpy, honestly. Lisa Shalett, Morgan Stanley, Wealth Management coming up. Alongside Brian Niconufi, Tom Kennedy at JP Morgan. There we go. Welcome back.
Is this grumpy?
Bloomberg surveillance, an interesting Tuesday here with some data with a continued market lift. Great to hear from Mike Wilson of Morgan Stanley. There's some of the nuances for it. Some real good, Lisa, some real good equity conversation to juxtapose what Anna Hahn said with Mike Wilson shows the narratives out there are very different.
And the difficulty to really come up with some sort of cohesive narrative at a time of such a disjointed recovery. That's what really stands out to me in general, how hard it is to game out something where you've already seen a recession in tech. You've already seen a recession take hold of the the goods sectors, and now the services sector is booming. How do you put this together in some sort of overarching call?
We're going to talk to Dana Peterson in a bit here about the American economy. But first, and Lisa, I thought since there's been so much talk here about Chairman Powell speaking in the next hour, we would get not a history lesson, but where are we with Michael McKee, our chief international economics and policy correspondent this morning. Michael, you and I remember HHH and Augustus Hawkins of California piecing together 45 years ago an interesting bit of legislation that had hope in it. And part of that was to force the Fed at gunpoint to come out and speak more often. Back then, Humphrey Hawkins' testimony was really illuminating, listening to Greenspan and others speak when we rarely heard from them. Now they speak every 15 minutes. Your life is absolute chaos. Do we need to hear from the chairman this morning?
Not particularly. I don't think anybody in the markets is going to hear anything that they don't already know from the Fed. And because we have jobs on Friday and CPI next week, Powell can't be very determinative in what he says about what the Fed is going to do because everything could be upset by what's coming. But you're right. In the olden days, when you and I used to walk 2 miles through the snow uphill to Capitol Hill
both ways
to listen to Alan Greenspan, both ways, yes, it was a big deal. And everything he said was parsed very, very closely. And that was, of course, in one of those hearings, the famous time when he said, if you understood what I was saying, then I must have been mistaken.
Mike, we have seen a shift in markets, the fears of runaway inflation, perhaps tempered by this disinflationary process that was started in January, perhaps less so last month. How much in D.C. has the narrative shifted beyond inflation to concerns about economic growth later in the year?
It's really not shifted so much as it's sort of fallen into silos. And they're really based on politics. The Democrats on the Hill are very concerned about growth and about the idea of unemployment rising. The Fed's forecast is for something like 4.6%. You get that high, it's about 1.5 million job losses. Republicans are focused much more on inflation and try to score political points, arguing that Joe Biden's responsible for that. For the Fed, it's a question of how do you know which is going to happen, because the pandemic upset so many of the rules of thumb that they use. It's really hard to know whether we're going to see that kind of slowdown that would create 1.5 million more job losses, or whether inflation can come down more quickly than it has in past episodes.
Do these hearings tend to reveal anything, Mike? I mean, how informative, how newsworthy have these hearings been in the past?
Every once in a while, you get a statement out of the Fed chair that is either illuminating or something that's a slight mistake that the markets will jump on. Mm-hmm. But it really doesn't get you a lot. I was kind of wondering when you were talking to Mike Wilson, no argument against Mike Wilson, but if you're an analyst, do you have to say you got something out of the Fed, or is it fair to send out a note to people that say, well, he told us what we already knew?
This is a huge issue.
Where you're going to end up today.
This is really important, folks. Mike's busting my chops because he knows it's the third rail issue with me. For global Wall Street folks, no news is news. I can't emphasize that enough. When there isn't a lot of earth-shaking news, that's actually news within the continuum of trying to look forward. Mike, I got one final question, and I don't want to turn it into a fancy economic dissertation, but so much of this is based on a theory of what we will do post-pandemic with inflation. And to partition the theory, there are optimists like Olivier Blanchard that say we're going to work this out and we're going to get down to a regime that represents what we used to know. There's another group, and I will mention Ken Rogoff of Harvard, who say this time maybe we will set at a higher level. I know none of that's going to come up today, but is the Fed thinking about that?
Oh, yes. The Fed is definitely thinking about what comes next. The timing of when that next is way up in the air. But do we go back to an old normal? Do we go back to a new normal? What does it look like? And the best guess is that we're going to end up with a slightly higher inflation and Fed rate regime. They don't want to be zero again. They would like to be around 2 to 3%. And if they can get down there without causing a lot of shall we say, disruption to the economy, that's what their target is going to be. But all this has to play out over the next year or so.
Mike McKee, thank you so much. And again, McKee leading our coverage in Washington today with the testimony of the chairman. I'm always and forever going to call it Humphrey Hawkins' testimony. Dana Peterson doesn't call it Humphrey Hawkins. She calls it must listen. She listens to every single word, 2 days running. She's chief economist at the conference board. Dana, what I love about your work is its consumer foundation at the conference board, maybe a little business investment as well. You are heated that measured is not 50 basis points and that we've got a measured Fed that will stay measured and stay at 25 beeps, whatever that path is. Discuss the nuance of a measured Fed versus the jump condition that some are calling for.
Sure. I think that a 50 basis point hike is actually inflammatory or would raise a lot of concerns among markets and also consumers and businesses that the Fed is losing control over inflation, at least the fight over inflation. So I think the Fed's probably going to opt for more 25 basis point hikes, probably 3 more, maybe even more greater than that. Maybe we'll get to something close to 6%. It's not really clear, but it's really going to depend upon inflation and also the labor market and whether wages are starting to cool at all. And so I think that, certainly the Fed does not want to cause alarm and will probably go with 25 basis points in terms of interest rate hikes going forward.
Dana, you've got unique visibility into consumer confidence and, frankly, consumer spending, which is the engine of this economy. Are you seeing signs of softening materially or not really, because we are seeing that kind of wage increase that a lot of people have been waiting for?
It's interesting. Consumers are divided. In terms of the present situation, they're saying, we are fine. Most of us are working. Many of us who switched jobs are seeing wage increases. We may still have a little bit of spending, a little bit of savings that we can spend. We have credit cards. We're continuing to spend. However, looking at the future, they still say, hey, we do expect a recession at some point. We're concerned about job prospects. We're concerned about the business environment, and we're concerned about our own income. So it's really a mixed picture in terms of how consumers are feeling.
How divided is it in terms of the higher income and the lower income sectors? And I ask this as you start to see companies increasingly cater to wealthy individuals who still have more than $1 trillion of discretionary savings in their checking accounts. That's according to some metrics. And then you have the others who are looking at shrinking spending capabilities. How much do you see that reflected in sentiment?
Sure. It's interesting. In the last reading, folks making between $35,000 and $75,000 were the most concerned about the outlook. And indeed, when we look at what consumers are saying they're going to do regarding spending, they're saying they're not going to buy cars or homes, and they're even pulling back on expectations for going on vacation. And that's really important because that's a harbinger of what's going to happen in the services sector.
Dana, with all of the uncertainties that are out there, to me, the great divide is the domestic economy versus foreign dynamics. And of course, we look at that subdivided into this strange thing called domestic final sales. Does domestic final sales indicate we are near recession?
Well, it's a mix. Again, consumers certainly did spend a lot of money in January. They were pulling back on consumption late last year, but then there was a big spurt. But certainly when we look at business investment, that's already starting to roll over. And certainly investment in CapEx, structures, and the residential investment environment are all weakening. And really the last shoe to fall is going to be the consumer, especially with respect to purchasing services.
Well, this is the conference board expertise. Do you see the tea leaves there of a consumer that could fail?
Well, I think that's the tough part. Our leading indicators continue to signal recession. Indeed, they say that recession should be happening right about now, but consumers are defying all expectations. So I think we really need to see the data that's going to come out for February. Certainly January was a pretty good month in terms of weather. February was horrible. March was worse. And we'll see if that's borne out in the data.
Dana Peterson, I love that. We're going to codify that. That's going to be in all of our ads going forward, Dana. February was horrible. March was worse. Dana Peterson of the Conference Board, thank you so much. I just think, Lisa, it's just so incredibly important to take the algebra and subdivide out, this is the American economy, and then over here is exports, imports, inventory build, and all that dynamics.
I love what she just said there. Dana was saying that their leading indicators suggest we should be in recession right now, and consumers just aren't playing along. Consumers are going to spend, and they are spending. And this has been sort of the conundrum that has continued to power this incredible growth and inflation and pricing power, even in some places. It's just, when does that end?
Well, I go back to microcosm, and that each story will be its own story and not aggregated together. And you are going to have a select group of people that mint money, even in recession, whatever that level of recession is. And you're going to have a lot of others, quote unquote, flat on our back. That's a very scientific term there. And we're getting there now. We're getting some really moldy numbers out from some people. But then there's others that are like, let's go, China, 5% GDP, onward.
I'm watching jobs. That's going to be the key number for me over the next couple of weeks. Yes, CPI, but more jobs. And the number that we get on Friday, the fact that we've gotten 10 upside surprises consecutive, the longest streak of upside surprises on labor market reports from the United States going back decades to the late 90s. When you take a look at that kind of surprising upside momentum to job creation, when do we start to say we are misunderstanding something in a labor market that is unique?
I would suggest that what we're misunderstanding is the third tranche of the summit, what Blanchard calls the Biden stimulus, whatever your politics. The fact is we had a big pop, and it's there, and it's still there as it fades out over time, and that's all there is to it. Futures up 5, Dow futures up 16. The VIX, importantly, under 1918.79. Stay with us. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The job cuts aren't over at Facebook parent Meta Platforms. Bloomberg's learned the company is planning a new round of layoffs and will cut thousands of employees as soon as this week. In November, Meta eliminated 11,000 jobs. That's 13% of its workforce. The powerful sister of North Korean leader Kim Jong-un has issued a new warning to the U.S. and South Korea. Kim Yo-jong is threatening severe consequences if the two countries go ahead with joint military drills next week. Last month, North Korea threatened to turn the Pacific Ocean into a firing range if the exercises took place. Baker Hughes and HIF Global have agreed to develop technology to directly capture carbon dioxide from the atmosphere. HIF says that will speed up its plan to eventually produce 150,000 barrels of so-called e-fuels a day. Bloomberg's Alice Steele spoke with HIF's Meg Gentle.
We're creating a whole new industry. It's very, very simple. We're taking water and extracting the hydrogen from it, taking air, extracting the carbon dioxide from it, and putting the hydrogen and the carbon back together, you have hydrocarbons.
Supporters see e-fuel as a virtually carbon-neutral version of gasoline. It could be used to keep cars with internal combustion engines on the road for years. S&P Global Ratings has slashed Nissan's credit rating to junk. It's a blow for the Japanese automaker that struggled to boost profits in the years following the arrest of Chairman Carlos Ghosn and the industry's turn to electrification. S&P says it's unlikely that Nissan could make a strong recovery in profit and sales. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I was right, but I was also basing my views on the research that indicated that front-loaded policy would be a superior strategy to achieve the equilibrium. But on the other hand, we have to remember just how strong the external forces of inflation are or have been. And so, although I'm vindicated, I also recognize that the external forces were going to be there anyway.
An American in Paris. Well, no, not Paris, London, but we'll go with it. Catherine Mann of the Bank of England and also of superb international economics in America. Just a bang-up job for the Bank of England. She's been a hawk, which people are surprised, but given her efforts at MIT years ago, I guess I'm not surprised that Catherine Mann is towed a tough line.
It's interesting to see how the doves have become hawks. This idea that people who had erred on the side of not doing as much are now saying this is a different scenario given the inflation.
What's important here is to understand that if you do equities, bonds, currencies, commodities, all sorts of good things can happen. And what's great is at any given firm, the guy who's the quote unquote fixed strategist, it's always their fault.
Well,
it's you know, if it's equities, okay, you can Mike Wilson, just equities, partition that. But if you're a fixed strategist, every day it can be your fault.
Yeah, even worse, you're supposed to know what's going on at a time when it's very difficult to do so. Ian Steely understands the angst of that very clearly. He is international CIO for fixed income at JP Morgan Asset Management and joins us here in studio. And I'm so glad that you are, Ian, because I'm really struck by what Robert Holtzman said, the ECB Governing Council member this morning, that he potentially backs raising rates in Europe by 200 basis points more this year, potentially 450 basis point rate hikes. How outlandish is this? How much is this starting to actually gain traction?
So he's probably at the more hawkish end of ECB members. But I think the reality is the ECB have still got the inflation problem to deal with. So everyone over here is well aware that core inflation is coming down, albeit slower than the Fed would like it to be. That's not the case in Europe. You know, core inflation continues to move higher in Europe. The way the mix of core inflation is likely to be calculated over the coming months, it's going to continue to move higher. So the ECB, who were behind the curve, who were slower to the party of rate hiking than other central banks, is playing catch up. And it feels like they're going to have to go a little bit harder. Although I think we need to be clear, this is probably the top end of expectations.
The top end, perhaps. Extreme top end. That said, this comes at a time when so many people have been bullish on Europe. They've seen the surprise of a warmer than expected winter. They've expected to see perhaps more growth in tandem with inflation. Do you push back against that?
No, I think that's right. I think Europe has. I mean, there were big concerns about Europe last summer, the gas problems and the hikes. I mean, the Bundesbank, I think at one point was saying Germany could fall 5% GDP. And obviously that hasn't transpired. And now you've got an environment when Europe's coming out the other side. The gas tanks are much fuller than was expected come the end of the winter. And people are seeing a really good cycle out of Europe. And again, that goes into the problem the ECB's got to deal with. They've got the growth, but they've also got the inflation, and they're going to have to keep going.
Ian, coming out of the pandemic, and you've got one of the toughest jobs at your shop, and that is just simply looking across FIC, across all of commodities, currencies, and fixed income and such. What do the correlations look like for next year? How predictive or how tight are the relationships of fixed income, commodities, and currencies right now?
I think what you're going to see is you are going to see, obviously we saw a big correlation last year, not just in FIC last year, it was across fixed income, across equities, everything was going down in price. And I think we are going to see a bit of a difference this year because of the huge repricing that we saw last year in fixed income. Yeah. And then you've got, as I say, some central banks which are much further ahead. You've got, say, the Bank of Canada, who are likely to pause this week. You had a bit of more dovish message out of Australia overnight. You know, the Fed, there's a decent amount priced in now, and then there's the ECB and other central banks.
Whatever the relationship is, and I don't even want to go in, we don't have time here to go into, fancy talk, but do you assume that the dampening going through 2023 and 2024 is a normal, what's called synodal dampening, where we're just going like this, easing our way along? Or are we going to see more abrupt jump conditions within the relationships of fixed income, currencies, and commodities?
I think we're going to have a slower journey or a more smoother journey than we saw last year. Outside of the European Central Bank, I think the central banks want to slow down the pace of hiking, which is going to bring down market volatility. And then it's going to be a case of later in the year, how high do rates get? And then do we have to do some sharp decreases if we do start to see a slowdown?
And Lisa, this is just critical, the extension of the x-axis out, where people, and particularly financial media, were always like, what's June look like? And the real question is what does 2025 look like?
Exactly, especially once you've worked through some of this reset. Going back to this idea of the rate hikes that you're talking about, Why haven't we seen more spread risk in Europe? Why haven't we seen more contagion really feeding through to the peripheral spreads, the peripheral bond yields that typically would blow out in this kind of situation?
So I think there's a couple of things there. I mean, firstly, we did see that concern around spread risk in Europe last summer, when we had these big concerns around a slowdown. And as we've come through that and the slowdown hasn't materialized and economic growth and strength looks better in Europe, people are getting a bit more confidence around Europe, and we've seen that not just in peripheries, we've seen that in credit spreads, high yield spreads. They've basically come back down to pretty much be in line with where the US is trading. But I think you've also got a much more joined up Europe than I can really ever remember, with the recovery plan in place and the coordination that we've seen across Europe. So it feels that we haven't got that sort of spread risk, the periphery risk that we've seen through previous cycles and that we've all come to know over the last decade or so. And if that goes away, then actually there's some decent yields on offer owning some of these bonds. Which
is fascinating at a time when a lot of our guests come on and they say, perhaps people have overplayed the euro and people are perhaps overseeing what's going to happen with the dollar and the potential strength later on. Do you push back against that and say not only do you have upsides risk with respect to ECB rates, but also the strength, the resilience can maintain that?
I would say both of those, and I would also add just the flow dynamic. So if you think about what's been the case of Europe over the last decade, negatively yielding bonds. I mean, who wanted to invest in Europe? Who wanted to buy negatively yielding bonds? Well, that's not the case at the moment. Two-year Germany now at 3%. You're getting north of 4% across the Italian curve. You're getting 7.5% across the European high yield mix, and that's before you even move into the dangerous world of equities. So I think there's just a lot of demand that will come back into fixed income. People who haven't wanted to own European fixed income for a long time.
Where on duration are you then? I mean, on a global basis, is there comfort in the belly? Do you have to go short term? I'm hearing that you don't, or can you actually be brave like the equity people and extend out duration?
So I think you still want to. So we're still playing for the curve to actually flatten a bit further from here. We think there is still concerns that the central banks around the world maybe have to do a little bit more that's priced. Although the repricing that we've seen over the last few weeks has been very helpful. And then really it's the back end of the curve that gives you that ballast in a portfolio. Right. That's the bit of the curve that will do very well if things go badly and suddenly fixed income yields move higher, and the capital gains could come from that part of the market.
Can I ask? Okay, I will. Ian, I'm asking for a friend, and you load the boat on the 97-year Austrian peace right now, down 71% from its peak. I mean, do you extend duration out?
I don't
97 years?
So that is, I think that now is, we were looking at it last week, I think that is now at the lowest price on the 100-year bond there.
Thank you. We noticed that earlier. Yes, we did notice that. Continue.
So I think, obviously, then you've got to take into account that's obviously the European curve, where there must possibly more still going through from an ECB standpoint. I think in the US, if you want to go out and you look at the 10-year part of the curve and you're 4%, maybe it goes to 4.25. I can't see it going a huge amount higher than that. And that means that over the next few years, that looks like a decent investment. And I think, buying bonds, definitely more attractive than they were at any point last year. And thankfully, the rally that happened in January has reversed a bit to give us another opportunity to go back into the market.
Don't be a stranger, Ian. Lovely to see you in our New York studios. So was that enough bond talk, Bramo, for you?
So I'm looking right now at the Austrian 100-year bond.
Oh, are you?
And it's trading at 41 cents on the dollar.
Yeah, well, I bought it like at 114.
Yeah, exactly. It was up there at one point and is no longer.
Yeah. There's a lot of people doing that. I mean, this is serious stuff. We had a guest, folks, a couple days ago saying basically fossils are going out and they're buying coupon. They're being maximum yield hogs. And they're just saying to their kids, you take the price decline down the road.
Yeah, well,
that's not a small issue.
No, I remember when I was a kid, my grandfather giving me some treasuries and basically handing me the certificates.
You got a 14% coupon treasury?
Well, and he had bought them a long time ago. It was a great deal. It wasn't, this is bad. It was actually a really good thing.
You sold it because you needed a new transmission in Fargo, right?
Well, let's not talk about that either.
It is an interesting day ahead here. In an hour, I believe, testimony. And, of course, the important headlines that Michael McKee will give you of a testimony of the chairman of the Federal Reserve System. Futures up 4, the VIX 18.79. I can't look at the Austrian price. This is Bloomberg.